A very good morning, friends. So I hope everybody is doing well. So we've got a very interesting standard for the day, and that's Ind AS 23, which talks about borrowing cost. And typically, if you ask me, this is a very close standard to my heart as well. And I think you must be thinking, why is it a very close standard to my heart? Because I qualified my chartered accountancy, and at that time, there were not many accounting standards in India. There were almost like 15 accounting standards at that time. And accounting standard 16, I'm talking of the IGAP, accounting standard 16, which deals with the concept of borrowing cost, was introduced at that point of time. So I remember, that as a qualified chartered accountant, the very first standard which I read as a qualified CA was supposed to be accounting standard 16. And I think you'll definitely agree that the perception, when you are looking at a particular standard as a student perception, and when you're looking at a standard as a qualified CA, the perception is very much different indeed. You got a little more practical oriented approach because the objective is not to pass the exams when you're reading a particular material, but the objective is, of course, to get a good conceptual clarity on the standard as well. So Ind AS 23, takes me back to the memory lanes when I read Accounting Standard 16, which was issued way back and it was applicable in 2001. But of course, I qualified in 99, and this standard AS 16 was introduced in 2001. But of course, we're not talking in terms of AS 16. We are talking in terms of Ind AS 23, which deals with the concept of borrowing cost. Now, one of the challenges, which I saw that when I was looking at this particular standard, good morning to all of you. So one of the particular challenges which I saw in terms of the standard was that if I were to summarize the entire standard in a couple of words, maybe a few lines, then how would I bring out the essence of the standard? So what I'm going to do at the first instance, because we're going to start and we're going to finish the standard in one session itself. So what I'm going to do, I'm going to give you a summary. And in this particular summary, I'm going to highlight a total of 7 keywords to you. And with the help of these 7 keywords, we're going to understand the entire concept of the standard and also the related technical terminology as well. But of course, the summary would not mean that the standard gets over at the end of the summary. We'll also get on to the next phase of the standard, which is the accounting part. So I think let me first of all begin with the summary in terms of Ind AS 23. So you can maybe note this down with me. So I'm just making a summary of the standard Ind AS 23 in which I'm going to highlight a total of 7 key important words which we need to understand. If an entity borrows funds, comma, borrowing cost directly attributable to construction, acquisition, production of a qualifying asset. So if an entity borrows funds, borrowing cost directly attributable to construction, acquisition, production of a qualifying asset before the asset is ready for use, is eligible for capitalization, And we just put down a sentence in the brackets. Any borrowing cost incurred thereafter, is to be expensed off. Any borrowing cost incurred thereafter is to be expensed off. That's it. Well, this is the essence, I would say, in terms of Ind AS 23, and I just call this as a summary, or you can say it's the summary, or you can say the key essence of this particular standard. Now, what I'm going to do, I'm just going to underline a few key words which we're going to understand, because if I want to appreciate what is written in this particular summary, then I think there are certain key words which we need to understand. And let me underline a few words. So when I said if an entity borrows funds, let me underline the word borrows funds. This is my term number one. We'll elaborate what do you mean by borrow funds. Borrowing cost, that is my second key term. Directly attributable, that is my third key term. And then construction, acquisition, production, that is my fourth key term. Of a qualifying asset, that is my term number 5. Before the asset is ready for use, that is my term number 6, ready for use. Is eligible for capitalization, that is my term number 7. That's all. So we've got a total of 7 key terms which we need to understand in this particular summary, and we'll be able to get the essence of this standard. So I've written, if an entity borrows funds, the borrowing cost directly attributable to construction, acquisition, production of a qualifying asset before the asset is ready for use is eligible for capitalization, and any borrowing cost which is incurred thereafter is going to be expensed off. That means treated as revenue expenditure. Now, before I elaborate on these 7 terms to you, I think I'm going to first of all give you a little more inputs before I come to these 7 terms, not necessarily in the same order, but we're going to understand these 7 terms one by one. So I think let me begin the journey, first of all, giving you some more inputs on this particular standard. Now imagine that this is a profit and loss account of the company. I'm just making a T-shaped profit and loss account just to understand the concept. So let's say this is the profit and loss account, and this is the income side, and this is supposed to be the expense side. So we're taking the profit and loss account in a T-shaped format where I'm taking the incomes and expense on each of the sides. Now, you would definitely agree with one of the inputs. Can I say an asset definitely gives you an economic benefit, but what is the timing factor when the asset is going to give you economic benefits? So we can say that the asset is going to give you a future economic benefits, but these future economic benefits would arise at a certain point of time. And that is when the asset is ready for use. Or I would ask you that the asset is put to use. I think, let me ask you something. What do you think on a logical front that an asset will give you economic benefits at what point of time? When the asset is ready for use, or do you think when the entity is going to actually put it to use, when would it generate economic benefits? I think I might get a mixed response on that. Some of you might say that it is ready to use. I think Sumit tells me ready for use means put to use. No, they are 2 different inputs. If the asset is ready, the management may not still put it to use. So put to use means that it has been actually, you started using that particular asset. But I think one thing is very clear. I would now say, when is the asset capable? Rather than saying that when does it generate economic benefits, rather we should say, what is the date when it is capable of generating economic benefits? Then I think the answer to my question would become more easy to answer, that it is the date when the asset is ready to use. The management does not put the asset to use, but the moment it is ready, it is capable to generate economic benefits. So now the issue is that if a company, for example, takes a loan to construct a particular asset, and it is going to incur an interest cost on the loan, and you tell the company that you please put this interest in the profit and loss account, what will happen? It will lead to an unmatch of cost and revenue principle. Because on one side, there is no revenue generated, but on one side, you're booking an expense in the form of interest. It'll lead to mismatch in terms of cost and revenue principle. And I think it will definitely overburden the company, and the company will incur a loss to the extent of the interest. So the standard setters had something in mind. I would say it was to the advantage of the industry, that if a company is taking a loan to construct the asset, naturally the asset cannot give you economic benefits until and unless it is ready for use. So they thought that if a company is incurring an interest on that particular loan, why not allow capitalization of this interest? So what happens, let's say, for example, if you're constructing a PPE, and this interest is added to the PPE, so the value of this asset would increase. And this would increase, you can say, the future depreciation, which is going to be taken on the asset. Because once you capitalize the element of interest in the asset cost, then this will increase the value of the asset, and correspondingly, you can say it would increase the depreciation as well. So indirectly, can I say that the interest which you are paying on a loan is getting spread in the form of depreciation on the asset? And I think it makes sense, because once the asset is ready for use, you are generating economic benefits, and against which you are claiming an expense, which is in the form of depreciation, which also includes the interest which you have paid on the loan as well. So I think we can say that this standard is definitely giving an advantage to the industry, and at the same time ensuring the concept of matching of cost and revenue principle. So this is the main, you can say, the thought process of the standard setters in terms of creating this standard. Now, I think if I just like to come back to the summary. So now you can just, look at the summary with a simple wordings right now without getting into the technicality. So it says if an entity is going to borrow funds, then the borrowing cost on the apparent front, you can take it as an interest for the time being. So if an entity is going to borrow funds, the interest which is directly attributable. Now, let me tell you one thing at this stage. The word directly attributable is being used in a couple of standards in Ind AS. And when you say directly attributable, it basically means something which is unavoidable in nature. It basically means that something which is unavoidable in nature. That means you should be able to prove as an entity that if you would not have borrowed these funds, the construction of the asset could not have taken place. It is something which is unavoidable in nature. So if an entity is going to borrow money and the interest is something which is unavoidable, which is related to construction, acquisition of an asset, not every asset is going to be eligible for capitalization. There is a definition which is given, a qualifying asset. But what is important is before the asset is ready for use. So if you're going to incur an interest cost on a loan which is being used for the construction of an asset, provided it relates to the period before the asset is ready to use, it is eligible for capitalization. I think a basic thought must be very clear. Now, I think having understood this, I think let me now start taking you to each of these 7 terms one by one. Okay, so now moving further with you, I'm going to first of all, focus on one very interesting word, which generally we tend to ignore. And the word which I'm going to look at right now is the word, what I look at is eligible. I'm going to first of all look at the word that is eligible for capitalization. Now, hear this very carefully, because what I'm about to tell you, this might be, the first time you're hearing those things, because generally at the intermediate level, when you're doing accounting standard 16, we may not be looking at the word eligible with such a depth. Now, let me, I think, take an example. Let's say, for example, you are looking at a building. Let's say, for example, you are looking at a building, and if I would ask, what are the applicable standards which are applicable to a building, you would say that Ind AS 16 applies to a building because it is a property, plant, equipment. So this standard would apply. But I would say there is another standard which is applicable to the building, and that is Ind AS 36. Because Ind AS 36, which deals with impairment, also ensures that, the carrying amount of the building, we need to ensure that the carrying amount of the building should never exceed the recoverable amount of the building. So we can say, if I were to say, is there any measurement principle which is given in a particular standard, which tells you that you need to restrict the value of the asset to a certain amount. So I would say Ind AS 36 applicable to a PPE. Well, Ind AS 36 is not only applicable to a PPE, there is 16, but is also applicable to Ind AS 38. It is also applicable to Ind AS 40. All these are non-current assets, whether they are tangible, whether they are intangible items, or like, for example, investment property, which though is tangible, but related in a separate standard. But you can say Ind AS 36, is got a measurement principle that the carrying amount of the asset cannot exceed a recoverable amount. Now imagine that, let's say the building is got a cost, you're still under construction. The building is got a cost of, let's say, 20 lakh. And with the help of Ind AS 23, you identified the borrowing cost, which is eligible for capitalization. And we decided that 4 lakh rupees is eligible by virtue of Ind AS 23. So when you add the two, you get 24 lakh rupees. This is capitalizing the borrowing cost. But when I apply Ind AS 36 and I look at the recoverable amount of this building, let's say it is to the extent of 21 lakhs. Now, I don't think so I need to say anything further, but you would easily understand that if you're going to capitalize 4 lakh rupees, the carrying amount of the asset will exceed the recoverable amount. So this would lead to a violation of Ind AS 36. So let me now ask you a very interesting question. Does this mean that Ind AS 36 is the final authority in terms of taking a decision that how much you can capitalize? What do you say? Do you think Ind AS 23 is supposed to be the final authority and it tells you, okay, this is the amount eligible and you go to capitalize that? Or do we need to apply the measurement principles governing the qualifying assets as well? I think you'll definitely agree with me on that. Okay, I think you got a question. I think, Tanku, you said, how can economic benefits be ascertained before it is put to use? Okay, now that's a very interesting question. When you're looking at a capitalization of the asset, every standard, whether it is Ind AS 16 or it is Ind AS 38 or 40, requires you to fulfill a recognition criteria. And the recognition criteria tells you that future economic benefits are going to arise and they are probable in nature. Now, every company in a very idealistic situation would always have to make an assessment of the projected cash flows. For example, if you're looking at a PPE, the company will have to make a projections in terms of the revenue which will arise from the sale of goods when you're going to use that particular machinery. So the economic benefits arising from all these assets will be in the form of projected cash flows, the management would give you. And we've always got reason to believe that when you're capitalizing an asset, the projected cash flows discounted to the time value of money is always going to be more than the historical cost which you've incurred in acquiring that particular asset. But this is one exercise which needs to be supported in terms of the recognition criteria. So you can say the economic benefits are the projections based on the cash flow estimates the management will give you. You do a similar exercise at the end of each year in terms of Ind AS 36 as well. When you're looking at an impairment testing, you always look at a recoverable amount, and you know that you start looking into the VIU, which is the value in use, the present value of all the future cash flows. Great. I hope that answers your question, I guess. Okay, so coming back to the agenda, as I said, in my example, can I say Ind AS 23 is not the final authority. It cannot decide what amount will be capitalized. So let me do one thing. Let me say a sentence, and I think you can vouch me for that. If you're able to vouch me, then I think my concepts are going good. Can I say in terms of a building, or in terms of, let's say, a PPE, or let's say an intangible asset, or let's say an investment property, can I say the cost as per IS Ind AS 16, the cost as per Ind AS 38, the cost as per Ind AS 40, plus the amount which is eligible, as per Ind AS 23, we need to ensure that it is supposed to be less than equal to recoverable amount under Ind AS 36. I repeat. Am I saying that the cost of the asset under Ind AS 16 or under Ind AS 38 or under Ind AS 40 plus the amount eligible under Ind AS 23 should be less than equal to the recoverable amount under Ind AS 36? So Ind AS 23 can only tell you that what is eligible. It cannot tell you the final status of what will actually get capitalized. You need to apply the measurement principles under Ind AS 36 and see that the sum total of the cost plus the amount eligible should be well within a recoverable amount under Ind AS 36. I think you'll agree. Great. Now, let's take another example. Do you think, friends, inventory could be a qualifying asset because you've all done accounting standard 16 at intermediate levels as well? So do you think, I would be coming to qualifying asset later, but do you think an inventory could also be a qualifying asset? Yes, of course. If the inventory takes a substantial period of time to get ready for its intended sale or use, even inventory could be a qualifying asset. I think, let me say something point blank. And I think if you can vouch me, then I think my term number 1 eligible is done. Can I say the cost of the inventory as per Ind AS 2 plus the amount eligible under Ind AS 23 should be less than equal to, would you like to make a guess that it should be less than equal to what? In terms of inventory, I need to ensure that the cost of the inventory under Ind AS 2 plus the amount eligible for capitalization under Ind AS 23 should be less than equal to fill in the blanks. So it should be equal to less than what should be the answer to that. Let's see if we get answer on this. And that's wonderful, Rashmi. That's wonderful, Koshki. Wonderful. That's right, Tanku. Wonderful indeed. It should be less than equal to NRV as per Ind AS 2. Great. Trust me, if somebody were to tell me that which standards are dealing with the measurement principles of qualifying assets, I would say typically it is Ind AS 36. And typically it is Ind AS 2. These are the two standards which deals with the measurement principles governing the qualifying assets. If you're looking at the qualifying asset being inventory, you need to get the final capitalization figure by looking at NRV. If you're looking at a qualifying asset being a PPE or intangible asset or investment property, you would get a final capitalization amount looking at the Ind AS 36, the recoverable amount. Wow. I think we've understood one terms with you. So I think I focused on the one term with you, that is eligible. So I'm done out of the 7 terms, one of the terms that is eligible. I think next time, when you're revising this particular standard, and I think once you're going to go through the term eligible, one thing is very clear, it'll definitely ring bells into your mind that when you're looking at the word eligible, it means that Ind AS 23 is not the final decision-making authority. The final decision-making authority is the measurement principle governing standards. Okay, so that was the term number 7. I think for the term number 6, I don't want to say much, but I can say the term number 6 is basically telling you what? It is giving you a cut-off date. The word ready to use is basically giving you a cut-off date. So as far as the term number 6 is concerned, it's giving you an upper limit. So we are saying that you will be able to capitalize the interest only up to a certain date. And what is the date? It's not put to use. It is ready to use because the standard setters said that once the asset is capable of generating economic benefits, well, we will stop your capitalization. As a management, if the asset is ready and you don't want to put it to use, I think that's the management problem. You cannot give them a capitalization advantage if they don't use the asset. It is ready and you don't put it to use. I mean, that's a management issue. Okay. So I think the 2 terms are done. That is ready for use and eligible. Now, directly attributable also, I think I've already given you. That directly attributable means it is something which is unavoidable in nature. It is something which is unavoidable in nature. Okay, I have a very interesting question which I like to share with you on the concept of unavoidable, that it is directly attributable. The institute has also issued, the Accounting Standard Board has issued an education material on Ind AS 23. And I think sometimes it is good if you want to get a little more better understanding of this standard. There's no harm in terms of reading extra things, because at the end of the day, being a qualified chartered accountant, you're also going to be, dealing things in a practical life. So I think let's take you a very interesting case, which might be an eye opener as well, because this is a wonderful example which is given in the education material. So I think let me just connect you on the directly attributable concept. And there is a wonderful question in the education material. As you can see, question number 2 in front of your screen. It says PQR is in the process of constructing a large manufacturing plant in a backward area. Due to unavailability of housing resources in the backward area, it is also purchased a residential building which is used for housing the workers engaged in the construction of the plant. Now, what the company is doing, they are basically constructing a large plant. And in order to, put the workers in a house, because there are no residential areas available, the company also purchased a building, it says a residential building, where the workers are going to stay during the period of construction. The purchase cost of the building is met by a long-term loan which is taken from the bank. The company intends to dispose of the building once the construction of the plant is complete, assuming that manufacturing plant meets the definition of a qualifying asset. Well, the qualifying asset in this case is the plant and not the building. But the company has taken a bank loan to buy this particular building where the workers can stay during the construction of this building. So assuming that the plant meets the definition of a qualifying asset, would the borrowing cost incurred on the purchase of the building be eligible for capitalization? Now, you must be thinking that the company has taken a loan, and this loan is not for the purpose of constructing the plant, but it is for the purpose of buying a residential building. Now, with your prior knowledge, you would also say that the building is already ready to use, because if you're buying a ready-made building which is meant for residential purposes, it is undoubtedly not a qualifying asset because it is ready for use at the time it is bought. So would the interest which you're going to pay on the loan for the purchase of the building, do you think it's going to become eligible for capitalization? I think, let me now tell you. What is important in this case is to understand that is it something directly attributable? Is it something which is unavoidable in nature? You want to construct a plant in an area and there are no residential stay available in that particular place. So can I say, if you want to construct the plant, you need to create some residential building in that particular area. So I think it was something which was unavoidable for the company PQR, that they had to buy a building, otherwise the construction of the plant could not have taken place. So this is something which is unavoidable, is something directly attributable in nature. Though it does not relate to a qualifying asset, but still the amount of interest which you're paying on this particular building is going to be eligible for capitalization under Ind AS 23. I hope my point is very clear. The idea of showing you this example was to give you an emphasis that what is directly attributable. I think these words, directly attributable, the word eligible, are quite underrated words in terms of the standard. I generally feel, when, as intermediate level, sometimes when you're looking at these standards, we do not really put a little weightage in terms of the word directly attributable and the word eligible. So I hope I am pretty clear with the concept on this. Okay, I think the answer was already available with me. That's wonderful. That's rightly given. Okay, great. So we are done with, I guess, almost 3 terms with you. The word ready for use is done, cut-off date. The word eligible is done. The word unavoidable, directly attributable is done. So 3 terms are taken care of. Now let's go to the 4th one, that is construction, production, and acquisition. Well, I think if you ask me, construction, production, acquisition are not technical terms as such. Because technically, if you ask me, these terms are not something which is technical indeed. When you're looking at the word construction, or when you're looking at the word acquisition, or when you're looking at the word production, it all depends upon the nature of the qualifying asset. For example, you can construct a building, you can acquire a building, but you cannot produce a building. It would be a wrong English language to say that we are producing buildings. You can construct a building, you can acquire a building. Similarly, if you look at inventory, inventory can be produced. We always say that there is a production of inventory. We can also acquire inventory, but we cannot say that as far as inventory is concerned, it has been constructed. It would be a wrong English language to say that there is a construction of inventory. So I think the words acquisition, construction, production is all, a matter of depending upon the nature of the qualifying asset. If the company is looking at a qualifying asset being inventory, then you can produce inventory, you can acquire inventory. If you're looking at a PPE, you can construct a PPE, you can acquire a PPE, but you cannot produce. So these words are nothing but they've been used considering what is the nature of the qualifying asset. Well, there is no technicality involved in these words. It's a synonymous in terms of the nature of the asset. Okay, so I think we've done a couple of terms with you. So if I just come back to the summary, I think I'm left with 3 terms with you. I've explained directly attributable, unavoidable. Construction, production, acquisition depends upon the nature of the asset. I've explained the word ready to use. I've explained the word eligible. So I'm only left with 3 important terms. One is borrow funds, one is borrowing cost, and one is a qualifying asset. So I think now let's go one by one on these terms with you. So I am now coming to the leftover 3 terms to you. The first term which we are considering is borrow funds. Let me now highlight something very important at this particular stage. Does the application of the standard require an enterprise to go in for a debt? Because we know that when you look at a funds, there are 2 kinds of funds which are there in a company. One is equity funds and one is supposed to be a debt funds. The question arises, for the purposes of this particular standard, is it necessary that a company should take a debt? I would say yes. If the company is going to construct, acquire, or produce a particular asset through equity financing, Ind AS 23 advantage is not available. So if you're going to use, for example, the money raised from equity share capital, or if you're going to raise money even from a preference share capital, which is classified as an equity instrument as per Ind AS 32. Mind the words, even if you're using the money from a preference share capital, which is classified as an equity instrument under Ind AS 32, you cannot get the advantage of the standard. If the company is using its retained earnings for the purpose, you cannot get the advantage of capitalization, because what is important for the application of the standard is that you need to have a debt financing. So there should be an actual debt which a company has taken, and there should be a payment of actual interest which you have paid. I'm being very clear on my words. The company needs to have an actual debt. The company needs to pay an actual interest. Notional interest also will not be eligible for capitalization under the standard. Unless the company has taken an actual debt and it is going to pay an actual interest, you cannot get the benefit of capitalization. So we can say what is important is that there should be a debt. So if the company goes in for a construction of an asset through own funds, the company has got certain surplus funds with them and they want to go in for a construction, the advantage of Ind AS 23 does not come to the company. So what is important is you take a loan, you take a debt, and then only you get the benefit of capitalization. Okay, so I think the concept of borrows funds, I guess, is also pretty clear. Now let's come to the 2 most interesting terms, and this is, one is the word qualifying asset, which I need to understand, and one is the word borrowing cost, which we need to understand. And this is going to take a little time. I think we're going to spend almost in 1 hour's time. in terms of understanding the word qualifying asset and a borrowing cost. And then I think we can take a quick recap of the 7 terminologies with you before I take you to the concept of accounting. So let me now begin the journey in terms of qualifying asset and the word borrowing cost. When I look at a qualifying asset, the first thing is I want to look at a definition. So I guess, friends, so far so good. You've all been able to catch up with the concept so far. I think everything is going pretty well. You've been able to, I think, get the essence of the standard so far. Now, let me come to the concept of a qualifying asset with you. Now, when I look at the concept of a qualifying asset, I think I'm going to first of all look at the definition of a qualifying asset, which is given in the study material as well. So I'm coming to the study material on page 7.239, and I'm wanting to look at the definition of what is a qualifying asset. So let me first deal with the definition of a qualifying asset, and this is what is given on the definition on page number 7.241. I just like to read something and then I'll elaborate, what exactly is a qualifying asset. It says a qualifying asset is an asset that necessarily takes a substantial period of time to get ready for intended use or sale. So the definition is very small and crisp in nature, that it is an asset. Now, let me first of all focus that it is an asset which can be tangible and it can be intangible as well. But what is important is that it necessarily takes a substantial period of time. Now, what is substantial period of time is not been defined in the standard. We're not given any specific guidance on what do you mean by substantial period of time. Though, if you look at the interpretation in the education material, there has been a reference that generally it should be a period of 12 months or more, but it all depends upon the facts of the case. You cannot say that 12 months is, categorically a cutoff factor. So it could be a period less than 12 months as well, which could mean that it is a qualifying asset. But generally, we can say that if the asset is going to take 12 months or more than 12 months time, then we can say it is a qualifying asset. And what is important is that it takes a substantial period of time to get ready for intended use or sale. The word is very clear, intended use. So I would like to also focus on one thing. Sometimes the asset may be capable of independent use, but the management does not intend to use the asset on a standalone basis. For example, a company might acquire some generators, and these generators might be capable of independent use. But let's say the management is trying to build, let's say you can say an entire power generation facility, and they want to use all these gensets as a part of a larger project. Now, since the intended use is to use it as a part of the larger project, you will not be able to say that it is ready for use. So what is important is that it's not ready for use in generic. What is important is that it is ready for use or ready for sale, what the management intends. The intention of the management is a very vital element in terms of deciding whether an asset is a qualifying asset or not. So I would say that there are two main focus in terms of the definition of qualifying asset. One is that asset is going to necessarily take 12 months or more to get ready. And what is important is that it should not be ready. It should not be ready for intended use or sale when acquired or while it is being constructed. So whatever the management intends, it should not be ready for use when you acquired it. It should not be ready for sale when you acquired it. Or if it is still under construction, it's not ready the way the management wants. So it will take at least 12 months or more time generally before it gets ready for intended use or sale. Okay. Then there are a couple of examples which are given in the standard, and it tells, a little subjectivity that depending on the circumstances, any of the following may be qualifying assets. The word is very clear, may be qualifying assets. And you're given a couple of examples like inventory, like manufacturing plants, power generation facilities, investment properties, intangible assets, bearer plants, etc. Then he also tells you that financial assets and inventories that are manufactured over a short period of time are not qualifying assets. Okay, you want me to give you a little, you know, interesting knowledge, a little knowledge which gives you an edge over others. So you want me to give you something more? I think Sumit has got a question. Can this period also depend upon the operating cycle of the company? Well, I would say no. If you're looking in terms of that, whether it depends upon the operating cycle of the company, I would say no. Okay, I think another question which I think Viraj has got, applicability of Ind AS 23 for debentures. Well, if you're looking at debentures is a fund that it is supposed to be a borrowed funds for the purpose of capitalization, yes. What is important for the application of the standard is that there must be a debt. A company should take a debt, and if there is an actual debt on which you're paying an actual borrowing cost, then yes, you definitely get eligible for capitalization. Okay. So now my question, friends, to you. I hope that answers your question. I think Sumit, Viraj. Okay, now you want me to give you a little extra edge over others when you're looking at the concept of a qualifying asset. Because when you go through the standard, and as I said, when I did this standard, I did this standard as a qualified C, and the perception is a little more different as compared to when you're doing it as a student. So when you go through the standard, when you go through the interpretations which are given in the education material, and you look at how the industry is functioning, you get a little very interesting insight about things. Okay, so let me, I think, now tell you. If you ask me, I would say there are three categories of qualifying assets. You heard me correct. I would say there are three categories of qualifying assets to give you more clarity on the subject. I would say category number one. The category number one is which is undoubtedly a qualifying asset. There is no dispute. At least I can say that, generally 99.99%, the category one would include assets which are undoubtedly qualifying assets, provided, of course, the parameters are met. Then I would say there is a category number two. Which I would say outrightly is not a qualifying asset. Undoubtedly, I would say these are not qualifying assets. So I think life would become more simple if I were to give you a list of what is, a qualifying asset for sure, what is a qualifying asset, not a qualifying asset for sure. Then there is another category number three as well. And this category is what we call that in this case, the company has got a choice of accounting policy. Wow. The company has got a choice of accounting policy. You may decide not to apply Ind AS 23. Okay, let me ask you a question. If a company is applying Ind AS 23, and is it mandatory that I would capitalize the interest? I would say in certain cases, no. I would say in certain cases, even I know that there is a qualifying asset, in certain cases, I may decide and I choose not to capitalize. I think I'd like to show you something very interesting. Let me just take you to the study material. If you go to the study material and you start looking at the scope of the standard, in terms of the scope of the standard, you will see something very interesting which is given. And let's look at the inventory in point B. It says inventories that are manufactured or otherwise produced on a repetitive basis, even if they take a substantial period of time. This exemption acknowledges the difficulty in allocating the borrowing costs to such inventory. So I'll tell you in simple word, what does this mean? Now hear me very carefully. I'm typically talking in terms of inventory. When you're looking at inventory, I would say there will be two different categories of inventory. If the inventory is ready for use or sale, or if the inventory is produced in a short span of time. If you produce the inventory in a short span of time, it cannot be a qualifying asset for sure. But if the inventory is being produced and it takes a substantial period of time, now the management has got a choice. Ind AS 23 gives a management a choice of an accounting policy, because sometimes it will be very difficult for the management, to identify that what is the borrowing cost incurred in producing that particular inventory. So the management may face, practical difficulties in terms of identifying what is the amount of borrowing cost which is directly attributable to the production of inventory. So the standard gives a choice. It gives you an option. It gives you a choice. It gives you an option that even if the inventory is taking a substantial period of time, you've got a choice and decide, no, I don't want to apply Ind AS 23. So next time, if somebody tells you what is the status of inventory on Ind AS 23, you can say, okay, tell me, is it produced over a short period of time? I say yes. Undoubtedly, it's not a qualifying asset. I said that the inventory is being produced taking a substantial period of time. I'll say, okay, the management has got a choice. You want to apply Ind AS 23, most welcome. You don't want to apply Ind AS 23, you're most welcome. The company will indicate in their annual report and tell the stakeholders at large that we have chosen not to apply Ind AS 23 and not to allocate the borrowing cost. I hope, friends, I am clear with the thoughts. Great. I hope I'm pretty clear on my thoughts at this stage. So let's, I think, make a list of few examples to you. Let's give you a few examples on each of these categories where we are saying undoubtedly it is a qualifying asset, or we are saying no, it cannot be a qualifying asset, or the choice of an accounting policy. So this is the area where the management gets a choice, or I can say the management gets an option. Okay, if somebody were to ask me, give me examples which are undoubtedly qualifying assets, I would say PPE, which is covered under Ind AS 16. I would say if you're looking at intangible assets, covered under Ind AS 38. I would say if you're looking at investment property, that is Ind AS 40. And I would say if you're looking at biological asset, which is a bearer plant. I'm not talking of biological assets. I'm not talking of biological assets. I'm not talking of biological assets covered under 41. We're looking at a bearer plant, which is covered under Ind AS 16. So if you're looking at a bearer plant also, then we can say they're definitely qualifying assets in nature. And if you give me examples which are not qualifying assets, we can say if a company has got financial assets, are covered under Ind AS 32 and Ind AS 109, and they are all taken at fair value at initial recognition. All financial assets are taken at a fair value. Since they're taken at a fair value, capitalizing the interest would mean overstatement of the assets at more than the fair value. Therefore, the standard very clearly says that financial assets can never be qualifying asset. So for example, if a company makes an investment in another company and it takes a loan for the purpose of making that investment, do you think it can get benefit under Ind AS 23? Let me put it again. I think you might have done this kind of question earlier in your intermediate level as well, that if a company is taken a loan and they made an investment in a particular company, do you think you're going to get benefit of capitalization under this particular standard? And of course, the answer is no. We will not be able to get advantage of that. A financial asset, which is investment, undoubtedly no. Second, the example could be inventory. If the inventory is produced on a short period of time, if you're producing the inventory over a short period of time, then it's not a qualifying asset. And I think the most best example in terms of an asset where a company chooses an accounting policy is that if you're producing an inventory, which is going to take a substantial period of time, it depends. So the management cannot be forced to apply Ind AS 23, even if inventory being a qualifying asset. The management has got a free choice in this particular standard, and they can say that, we've got a practical difficulty in terms of identifying the capitalization amount. Therefore, I choose not to apply this standard. You can do that. Okay, fair enough. So I think we've got the inputs in terms of all the three categories. And I think just to make a mention, that when you're looking at the qualifying asset, so I said there are two more most important parameters. The first important parameters is that generally What is most important is that generally it should take 12 months or more. It should take 12 months or more to get ready. So unless an asset generally takes a period of 12 months or more, that is one. And to get ready for, the keyword is intended. The keyword is intended, use or sale. And you can see the standard uses the word use, because you're going to use a PPE, you're going to use an intangible asset, but you're going to sell an inventory. So qualifying assets could be meant for use, like a PPE. It could be meant for sale, for example, inventory. So the standard use the word intended use or intended sale. Okay, so I think that gives us a good picture in terms of the qualifying asset definition. My 6 terms are done. I am done with 6 terms out of the 7 terms. Now comes the interesting part, that is the term number 7. What we're going to deal with is the borrowing cost. So let me take it further. So let's go to the next term with you. And we are looking at now the next term, that is borrowing cost. Okay, I guess Sumit has got a question. Choice is only for inventory. Well, I would say the choice is meant for inventory, and there is another asset as well, which is a biological asset. But I think I'm not getting into that detail because that could involve a lot of technical discussion. So I would say yes, from the examination point of view, I would consider inventory is the only case where an accounting policy is required. But if you look at the scope of the standard, they brought 2 assets under the purview of this judgment. One is a biological asset other than a bearer plant, which is covered under IS 41, and the other one is supposed to be inventory. But I think from the examination point of view, I'm focusing just on the inventory part. Okay. Now let's come to the next agenda with you, which is, of course, the name of the standard. So I think let me before, give you a quick recap in terms of things. I think we're now in a little more position to understand the summary with which we started off. So when I started off with the standard, I gave you a summary. And I think now if you look at the summary, except for the borrowing cost term, which of course sometimes we take it as interest, we can at least get some good essence of our understanding. If an entity borrows funds, so I'm putting across a question to myself, is borrowing, is a debt important for the application of the standard? Yes. If the company uses its own funds, its equity funds for the purpose, would you get advantage under the standard? No. If you got a preference share capital classified as a financial liability, yes. If you got a preference share capital classified as equity instrument, no. If you've got equity shares, equity instruments, no. If you've got retained earnings, no. So what is important is that you must borrow. What is important is you must pay actual interest. A notional interest and opportunity cost concept does not apply in terms of this Ind AS. Then he says, if an entity borrows funds, then the borrowing cost, which for the time being we are considering interest, you need to prove that it is directly attributable. It's something which is unavoidable in nature. Had you not taken a debt, you would not have incurred a borrowing cost. You would not have been able to construct the asset. You need to prove the chain that without the funds being borrowed, the borrowing cost would not have got incurred and the construction could not have taken place. If you can say that the construction could have taken place even if the funds were not borrowed, then you are not covered under this standard. So you need to prove that the amount of borrowing costs you're incurring is something which is unavoidable in nature. And the borrowing cost which is being incurred for the construction, acquisition, or production. You may either acquire it or you may either construct or produce a qualifying asset. Not every asset is a qualifying asset. We've seen a list of 3 categories, one which will be, one which will not be, and one where a management would take a choice of an accounting policy, typically inventory. And we are giving a benefit of capitalization to the company, and the benefit of capitalization is only up to a certain cutoff date, and that's what we call is the date ready to use. Because the asset is capable of generating economic benefits till that point of time, so we will not allow a capitalization beyond that date. And the standard is not the final authority. The standard is only telling you what is eligible. The final decisions will be taken by the measurement by those standards which governs the measurement principles of these particular qualifying assets. Typically, I would say Ind AS 36, impairment, and if it is a case of inventory, then it is Ind AS 2, because inventory doesn't get covered under the concept of impairment, because inventory has got inbuilt impairment testing in the standard. Right. So I guess so far so good. I hope, friends, you're all been able to catch up with the concept so far with me. So I guess now we can go on to the last term with you out of the list of 7 terms which we identified. So I'm now going to look at the term borrowing cost. So we're going to spend some good time on this term now. Now, when I am looking at the concept of a borrowing cost, let me, I think, come to the definition which is given in the study material. In the key definition sections in the standard, we are given the borrowing cost are interest and other cost that an entity incurs in connection with the borrowing of funds. And you can see that there are 3 clauses which are given on the borrowing funds. I think let's look at things with a little different perception. I'd like to show you the definition in a different angle. You're going to love this. So I'll show you the concept of borrowing cost in a different angle. Just have a look at what I'm going to tell you. Well, if you ask me, I would say there are 3 possible situations which can arise. I would say there are 3 possible situations which can arise. One is that you take a loan in a functional currency. That you take a loan in a functional currency. I guess you're already aware of what is a functional currency. Oh no, I think the other day, I think Rashmi told me you yet to do Ind AS 21, I guess. So let me just tell you that what exactly is, just for the need of the standard, explain you that what is a functional currency. Well, you can say that earlier when we were in IGAP, that is accounting standard era, we used to say that if a company is, let's say, registered in India, it has got its office in India and it is registered as a company under the Companies Act 2013, I would say the company would make financial statements in Indian rupee. But in Ind AS, that's not the case. We're not concerned with, where the company is domiciled. The main concept of a functional currency is the currency in which the entity functions. Therefore, the word is called a functional currency. You need to basically identify what is the currency in which you're going to function. Look at the currencies in which your inflows and your outflow takes place. Every entity which is applying Ind AS is supposed to identify the currency which is called a functional currency. So you need to see that what is the currency in which the inflows and the outflows takes place. So that is supposed to be the functional currency. So the situation number 1 is that the company has taken a loan in a functional currency. And the situation number 2 is that the company has taken a loan not in a functional currency, but in a foreign currency. And then there can be another third kind of situation as well. And that is the company has taken an indirect loan. The company has taken an indirect loan. They've not taken a direct loan, because the first 2 cases are a case of a direct loan. That you are taking a loan from an institution. So you either take a loan in a functional currency or you take a loan in a foreign currency, but there could be an indirect loan. And the indirect loan is when you take an asset on a lease. Oh. So you know that when you take an asset on a lease, which is called as a finance lease, isn't that finance lease supposed to be an indirect loan? Yes, it is. Because basically, when you say that you've taken an asset on a lease from someone, and you say that it is a finance lease, the word finance lease indirectly means that you've basically taken a loan from someone. So what do you do in terms of a lease asset? You put the entry capitalizing the ROU asset in the books of accounts. And correspondingly, you create a lease liability in the books of accounts. But what is this lease liability? This lease liability indirectly is nothing but a loan. So am I indirectly trying to tell you that if a company takes a loan, a company takes an asset on a lease and it is not ready for use, am I indirectly saying that the interest on this lease liability is going to be a part of the borrowing cost in that particular case? Yes, you heard me correct. So if a company, takes an asset on a lease and you say that the leased asset is something which is a qualifying asset, so which means a qualifying asset can be an ROU asset as well, right? I didn't make that mention earlier, but I can say definitely if a company is taken an asset on a lease. So I like to go back to the qualifying asset and add another fifth element out here, that even a ROU asset, that is a right of use asset, which is covered under Ind AS 116, can also become, a qualifying asset for the purpose of the standard. But of course, the parameters need to be met that the asset is not ready for use when it was taken on a lease. So when a company takes an asset on a lease and the asset is not ready for use when it is taken on a lease, the interest which you're going to pay on the lease liability is also a part of the borrowing cost. Okay, now let's concentrate on these two cases. The first case which I'm looking at is that there is a loan taken in a functional currency. Now, if a company takes a loan in a functional currency, you would basically pay interest. But if a company takes a loan in a foreign currency, you know that you're going to pay interest as well. And you're also going to incur an exchange loss as well. Because we all know one thing, that when you take a loan in a foreign currency, the interest rates on the foreign currency loan is comparatively less as compared to the functional currency loan. Like, for example, if I am in India and my functional currency is Indian rupee, the interest which you're going to pay on the Indian currency loan is going to be much greater if I would have taken a loan in a foreign currency because of the exchange rate factor. So you can say when a company takes a loan in a foreign currency, there will be two associated costs the company would incur. One is the interest and one is, you can say, the exchange loss arising on that particular loan. So when you're looking at the definition of a borrowing cost, we can say if a company has taken a loan in a functional currency, we need to consider just interest. If the company has taken a loan in a foreign currency, we need to consider interest and exchange loss. And when you've taken an asset on a lease and it is not ready for use, the lease liability is indirectly a loan. And the interest on that lease liability will become eligible for capitalization. Okay. Now, friends, you want me to give you a little logic in terms of this exchange loss? Or you just want me to give you, the inputs that, okay, this is what the standard says and this is what is done. So if you want me to give you a logic, I'll give you a detailed logic as well. And if you want me to just give you the essence that, okay, this is what is done in a given situation, I can do that. Logics, I feel, is always better because once you understand the logics, they remain with you for a lifetime. The validity of the logics is far much beyond as compared to things without being done with the logic. So you want me to give you a logic as well? Okay, now a few questions, I think, Sumit. Borrowing cost would also include a processing charge. Yes. So I think let me first of all put that point right away. When you're looking at the interest in this particular case, this interest is based on the effective interest rate, which you calculate under Ind AS 32. So when you go to consider the interest, it is not the interest which is the contracted rate of interest. The interest is based on the effective interest rate. In fact, there has been a clarifications which has been given by the Institute in one of the Ind AS bulletins as well on Ind AS 23, that if there is a processing fee which you paid on a loan, then all that will be taken as a part of the calculations of EIR. Because, when you calculate the effective interest rate under Ind AS 32 as well, then the processing fees which you pay or any kind of, you can say, the transaction cost which is incurred, it all gets into the calculation of the effective interest rate when you go for the amortized cost calculations. So yes, that would also be taken. Then I think another question which I think Viraj says, whether a cost of convertible debenture is eligible for a borrowing cost or not. And that's a very interesting question. And there is no, guidance which is very explicitly given regarding the convertible debenture. Well, I would say that if you look at the things, you can say a convertible debentures would be segregated in terms of the equity element, and it would be segregated in terms of financial liability element. Considering that the convertible debentures would, in a very idealistic situation, become a compound financial instruments. So to my mind, well, there is no concrete inputs which are given in the education material or otherwise. But just to give you an answer, to my mind, I guess if you're looking at a convertible instrument, which is a compound financial instrument, and you've segregated the debt equity element, naturally the equity element is not going to be a part of the financial liability. So I think whatever interest you're going to calculate on the financial liability, the EIR which you're going to calculate on the financial liability should of course be covered. But I think, as we've already said, that we're not looking at the contracted rate of interest. The interest which you're considering for the purpose of the standard is the effective interest rate, which means what you should have paid, which doesn't mean that what you're actually paying. Because as we've already seen in financial instrument standard, the essence of the interest is not what is paid. The essence of the interest is what logically should have been paid according to the terms and conditions. You map the inflows and outflows, you get the substance of the transaction, derive the effective rate of interest, and that becomes the base. Right? I guess that answers your question, Viraj, and I think answers your question, Sumit. Okay, I think everybody's telling me logic. Okay, so let's begin with the logic. So I'm going to first of all take a case of the foreign exchange gain or loss with you. And then after that, once we've understood the concept, we're going to make some very interesting chart on the concept of this foreign exchange gain or loss, because there have been some very beautiful illustrations which are given in the study mat, but my concept will automatically take care of those illustrations. So let me begin the journey. Now, watch me on the calculations, what I'm about to do. And just watch these calculations, and then you're going to vouch me on this. Let's say, for example, there is a company XYZ Limited. There is a company XYZ Limited. And let's consider that this company has got a functional currency Indian rupee. So I'm considering that this company has got a functional currency that is INR. But this company took a loan in dollar. So they took a loan of $1 lakh. And when they took this loan, the rate of exchange at that time, $1, let's say, was to the extent of 70 rupees a dollar. So I think one thing I can definitely say that the company's financial need at that time was 70 lakhs INR. Because when the company took a loan of $1 lakh, then we can say the rate of exchange was 70. So the company actually needed, you can say, 70 lakh Indian rupee. Now, let's say the interest rate on this particular loan is, let's say, to the extent of 4% per annum. And let's say at the year end, the exchange rate, let's consider at the year end, the exchange rate changes to $1, let's say becomes to the extent of 72. So let's say it becomes 72. Now let me do one thing. Let me calculate first of all that what is the interest payable on this particular loan in INR. So I'm considering the calculation of the interest on INR. So we can say on $1 lakh, you would pay a 4% interest. And considering that it is unpaid at the end of the year, I apply a closing rate of 72. So the interest paid is 2,88,000. Let me show the workings once again. I have taken that you've taken a loan of $1 lakh and you paid a 4% interest on the same, considering that it is yet unpaid at the end of the year. So I've taken a closing rate of 72. And am I also getting a foreign exchange loss on this loan? Yes. When you took this loan, the dollar rate was 70. And at the year end, the dollar rate is 72. So you've suffered a loss of 2 rupees a dollar. So we can say on $1 lakh, there has been a loss of 2 rupees a dollar because the rate of exchange changed from 70 to 72. So you've got an exchange loss to the extent of 2 lakh. So if you effectively see that what is my total cost of organizing this loan, I would say it is 4,88,000. Because the company is not only paying interest to organize this loan, but you're also getting an exchange loss. So indirectly, we can say that the exchange loss is also a cost to me. So we've incurred 4,88,000. Now, my question, friends, to you. I think on a logical front that if the company would have taken a loan in Indian rupee, then I feel the rate of interest would have been 6.97%. Approximately, you can say the interest rate should have been 7%. I repeat, I'm saying that if this company would have taken a loan in Indian currency, which is the functional currency, they would have landed up paying, let's say, an interest approximately 6.97%. You can say they would have landed up paying a 7% interest. Agreed? Now, this is based on your little knowledge on what you might have done in financial management. So what do you think? Do you agree that if I would have taken a loan in Indian rupee, then the interest would have been at the rate of 6.97%? Let's see what are your reactions on that. And I think I am getting a yes. That was for the previous one, I guess. Okay, so I think I got a yes on that. Koshki tells me yes, that is correct. Okay, let me now elaborate this position to you. Have you done the concept of what we call interest rate parity theorem in financial management? Have you done the concept of what is called an interest rate parity theorem in terms of financial management? Maybe some of you might have done IRPT or some of you might not have done, but let me explain. Okay, not an issue. Let me explain this to you. Now, watch this carefully. Interest rate parity theorem tells me that if you take a loan in India, you pay interest. And if you take a loan abroad in a foreign currency, you pay interest and you get an exchange loss. And in a very idealistic situation, there should always be an indifference. There should always be an indifference. So basically, the indifference means that the sum total of the interest and the exchange loss on a foreign currency should always be equal to the interest which you pay on a functional currency. This is what the IRPT says, but this is something which is not bound to happen every time in a practical life situation. Because this is what we technically call a theoretical relationship. There will always be an indifference point, because if there is no indifference point between the two, what will happen? It will give rise to arbitrage gain opportunities. If I know that the amount of interest and the exchange loss in one country is not equal to the interest in the other country, I could borrow funds from one country and I could invest funds in another country and get a difference which is called an arbitrage gain. So theoretically, we always have reason to believe that there should be an indifference point. If you take a loan in a foreign currency, you land up paying interest, you land up incurring an exchange loss. So in a very idealistic situation, in a theoretical relationship, the sum total of the interest and the exchange loss should be equal to the interest which you pay on the functional currency loan. This is what the standard setters had in mind. They had it in mind that every time, whether a company takes a functional currency or a foreign currency loan, it should not make a difference to them. So now let's act as standard setters. So if you want to create an indifference point, between the two companies, let me say something, vouch me. If I want to create an indifference point, let's say one company takes a foreign currency loan and another company takes a functional currency loan, and you want to ensure that both of them get a same capitalization. So can I say a company which takes a functional currency loan, you tell them, okay, I will allow you to capitalize the interest. Now, a company which takes a foreign currency loan, and you want to create an indifference of capitalization figure. So you're going to tell him, okay, you can capitalize the interest. And you will say, okay, you can also capitalize the foreign exchange loss, but I will not allow the full capitalization of the exchange loss. Because if I want to create an indifference point, I'll tell him that you can capitalize this foreign exchange loss to the extent of lower of the two. I will tell him that you can capitalize the exchange loss to the extent of lower of the two. One is the actual exchange loss. One is the actual foreign exchange loss. And one is the difference in the interest between the two currencies. Take the difference in the interest in a functional currency minus the interest in a foreign currency, the difference in the interest. So you'll tell the person, okay, let me take a difference in this interest and compare it with the foreign exchange loss. So your actual loss or the difference in interest, whichever is less. Because I will not allow the entire exchange loss, because if the exchange loss plus the interest exceeds the interest on a functional currency loan, there will be no indifference. And in a situation, if he's incurred a less exchange loss, why should I create an indifference? Are you getting my point? So if a company has got an interest on a foreign currency loan and the actual exchange loss is less, I will not be able to create an indifference to them. And if the exchange loss is much more, then I would also like to restrict the capitalization. So we told them that we don't give you the benefit of entire exchange loss, but we will give you a benefit of the exchange loss to the extent of what you actually incur or to the extent of difference between the two, because we want to create an indifference. One company takes a foreign currency loan, another company takes a functional currency loan, and I want to ensure that both of them get the same capitalization advantage. Did you get the logic, friends? And this provision is there in terms of AS 16 as well. And the concept is based on the interest rate parity theorem. That if a company is taking a loan in a foreign currency and the company is taking a loan in a functional currency, we need to create an indifference point between the companies. We want to basically ensure that the company should get equal level of capitalizations, whether you take a loan in foreign or whether you take a loan in a functional currency. Am I pretty clear, friends, till this stage? Did you get the logic in terms of this? And somebody said, this is the same treatment which is given in terms of accounting standard 16. Yes, the same accounting treatment is undoubtedly given. So moral of the story, I think, let me just go back. Let me just come back to the concept of a borrowing cost. I'm pretty sure I might have slightly changed your perception in terms of looking at this standard, I guess. I think the kind of way you might have done this standard earlier at the intermediate level, I might have slightly changed your perception in terms of looking at the standard, focusing on the word eligible, focusing on the word directly attributable. And now I think focusing on the IRPD, I think we must be finding a little difference in the way we're looking at things. But this is interesting, I think. And I think this is definitely logical, I guess. Okay, so let me, I think, take it further. Let me just come back to the borrowing cost concept. So as we said, when I'm looking at the concept of a borrowing cost, I'm looking at three kinds of situations. I'm looking at that in a practical illustration. I might be given a loan which is a functional currency loan. I might be given a loan which is a foreign currency loan, or I might be taken an indirect loan because I've taken an asset on a lease. And even the lease is a finance lease, it is an indirect loan. And when you create a lease liability, it is basically a loan in the books of accounts. And if the lease asset is not ready for use when it is acquired, then the amount of interest which I pay on the lease liability becomes eligible for capitalization. Now, as far as a company has taken a loan on a functional currency, it's only going to pay interest. So is the interest going to be a part of the borrowing cost? Yes. But is it the actual interest or is it the effective interest? It is the effective interest. Secondly, if a company has taken a foreign currency loan, then they will get benefits of two components in borrowing costs. They will get a benefit of interest, again taken on EIR, and they will also get a benefit of the exchange loss. But are they going to get a benefit of the entire exchange loss? No. It will be allowed to the extent of lower of the two, because you want to create an indifference point between the companies. So you will tell them that whatever is the actual loss or you will tell them that whatever is the difference in interest, whichever is less, that becomes eligible for capitalization. So if they've got any excess exchange loss, that will be treated as revenue expenditure, right? I think we should do one small little example, at least on this area with you. So I think let's come back to the study material. And I think let's have a look at one of the questions on the area of this exchange gain or loss. So let's have a look at the illustration number 5. I'm just going to organize the data. This is on page number 7.245. So let's come to the page number 7.245, illustration number 5 of the study material. So just apply the logical concept and you will be able to get the answer. Page 7.245. Let's, I think, read the facts of the case and then take it further. It says ABC has taken a loan of $20,000 on 1st April X1 for constructing a plant at an interest rate 5% payable on an annual basis. On 1st April X1, the exchange rate was 45 rupees a dollar, and at the year end, it is 48 a dollar. The corresponding amount could have been borrowed by ABC from State Bank of India in a local currency at interest rate 11%. So we are indirectly presuming that the company's functional currency is Indian rupee, and they would have taken interest at the rate of 11%. Compute the borrowing cost to be capitalized for the construction for the period ending March X2. Now, let's organize the data. So on one hand, we are looking at a loan taken in functional currency. So on one hand, I'm taking the loan is taken at a functional currency. And the other hand, I'm considering that I've taken a loan in the foreign currency. So let's do the calculation. Let's first organize the data, and then we'll see what is to be capitalized. In a functional currency, all I'll do is pay interest. So I think I need to first of all calculate that if I would have taken a loan in functional currency on 1st April X1, can you tell me what would have been my financial needs at that time? I took a loan of $20,000 and the rate of exchange was 45 a dollar. So I would have taken a loan in Indian currency, that's 9 lakh, considering the rate of exchange at that point of time. So we would have taken a loan of 9 lakh Indian rupee. And the interest I would have paid is to the extent of 11%. So we would have paid 11% interest on this. So we can say on 9 lakh rupees, 11% interest would mean 99,000. So this is if I would have taken a functional currency loan, this is the interest I would have paid. Now let's calculate the interest I am actually going to pay when I took a foreign currency loan. So when I took a foreign currency loan at that time, the interest rate was 5%, but considering the interest is unpaid at the end of the year, when the rate is 48 a dollar. So we can say $20,000 loan is taken. The interest is at the rate of 5%. Considering it is unpaid at the end of the year, I'm taking a $48. So on $20,000, you pay a 5% at 48. So 48,000 is the interest paid. But then we're also getting a foreign exchange loss. We're also getting a foreign exchange loss. And I think the foreign exchange loss is the dollar rate from 45 changed to 48. So there has been a rate increase of 3 rupees a dollar. So we can say on $20,000, there is an exchange loss of 3 rupees a dollar. That makes it 60. And if you take a sum total of this, it is coming to 1,08,000. Do you think we'll allow a capitalization of 1,08,000? Of course not. We cannot give them an advantage because we need to create an indifference point. So we will not allow the company the entire exchange loss in this case. So let's see how much interest will be allowed. Number one, if you're going to consider the borrowing cost capitalization, what is the interest you will allow them? I will allow the entire interest of 48,000, which they are going to pay in terms of the foreign currency loan. But what about the foreign exchange loss? Can I say the foreign exchange loss will be allowed to the extent of the lower of the two? So we will give them the benefit equal to the lower of the two. We'll say, okay, what is the actual exchange loss? We'll say, what is the actual foreign exchange loss you have incurred? We'll say it is 60. But we'll say, okay, let's see that if you want to create an indifference point, then what is the differential interest? If you want to create an indifference point, then what is the differential interest? So differential interest is 99 minus 48. The differential interest is 41. So in order to create an indifference point, we will allow them the lower of the two. So 41,000 of the exchange loss will be allowed. So which means that the company is incurring another additional exchange loss of 19,000. So what happens to that 19,000? It will be debited to the profit and loss of the company. So any amount of exchange loss in this particular case is going to be debited to the profit and loss. So if the company would have taken a loan in functional currency, they would have got a benefit of 99. So I would not allow them a benefit of 99. In other words, I can say that out of that exchange loss of 60,000, you can say 48,000 is supposed to be as good as interest. We can say out of that 60,000 exchange loss, we can say 48,000 is as good as an interest cost. And the 12,000 is the exchange loss, which will be taken in the profit and loss account of the company, creating an indifference point for the company. Right, friends, I guess I am pretty clear on the concept of this borrowing cost to you. Okay, so this is done. And okay, I think Koshki, you got a question on this, that if we have a foreign exchange loss, why we're taking the interest at the rate of 48? It should be 51. Okay, my mistake on the calculations. The difference is, yes, you're right, it is 51. My mistake, the difference is 51. So this difference is going to be 9,000. Okay, thanks. Okay, now the question, Koshki, you said, why are we taking the interest at the rate of 48? Well, considering that the interest is not yet paid at the end of the year, so we can say that the company would actually, have to pay the interest at the exchange rate, which is a closing rate, because the outflow of the companies will take place at the closing rate. So I'm considering that they've not paid it during the year, they're going to pay it at the end of the year. Therefore, a closing rate is applicable, right? Okay. Right. Now, this is one part, but the concept of borrowing cost is not yet done. The concept of borrowing cost is not yet done. There is something more now we need to see on the concept of a borrowing cost. Now, there is something very interesting which is given in the standard. So let me just take you to the concept of another input which is given in the standard. See what is given out here on page number 7.244. There is a clause number 2 which is given. And I think I'll explain this with an example, but let's first read what is given in the point number 2. Where there is an unrealized exchange loss, which is treated as adjustment to interest, and subsequently there is a realized or unrealized gain in respect of the settlement or a translation of the same borrowing. The gain, to the extent previously recognized as an adjustment, should also be recognized as an adjustment to interest. Oh my God, quite a technical language. I think let's illustrate this with an example to you. This is now a position which you might not have done in terms of accounting standard 16. This is something which was not there in A16, but this is there in terms of Ind AS 23. Now, let me tell you. The standard in terms of the borrowing cost definition is looking at two things. Now, hear this very carefully. It's a very simple concept, and if it clicks in seconds. Let's consider this is year 1, and let's consider this is year number 2. On a time scale, let's consider this is year 1, and let's consider this is year 2. Now, we are looking at a borrowing cost for year 1, where I'm looking at that there is a foreign exchange gain or there is a foreign exchange loss, though we have not talked about a gain, but let me talk about a gain as well. So I'm looking at year number 1. When you're looking at a foreign exchange difference, the foreign exchange difference can be a foreign exchange gain or it can be a foreign exchange loss. If a company gets a foreign exchange gain, it's not a part of the borrowing cost, but it will be credited to the profit and loss of the company. You cannot say that a foreign exchange gain in year one is supposed to be a negative borrowing cost. If the company is having a foreign exchange gain, it will be simply credited to the profit and loss. It's not a negative borrowing cost. But if you get a foreign exchange loss, we've already seen that you will be able to allow the lower of the two. That is the actual loss or the interest difference, and that will be treated as a borrowing cost. So we can say that if there is a foreign exchange loss, you can say one portion will become a part of the borrowing cost and another portion will get excess, will get debited to P&L, right? So I would say it like this, that in year number one, if a company gets a foreign exchange gain, it goes to the P&L. If a company gets a foreign exchange loss, to the extent of lower of the two, the net result accounting is that some portion, which is the lower of the two, becomes a part of the borrowing cost and the excess portion is debited to the P&L, as we saw in the previous illustration. Now, the standard also focuses on that in a subsequent year. It talks about that if in a subsequent year, you again get a foreign exchange difference. If you again get a foreign exchange difference, then how do you treat that foreign exchange difference? So we are now focusing on that there is a gain or loss which is arising in a subsequent year. You've already taken care of year one and now you are in year two. So I would say, let's have a look at the permutation combinations which could arise. Let's imagine in year number two, what kind of permutation and combinations could arise. The permutation combinations would be something like this. Let's say this is year one, and let's say this is year number two. And the first permutation combination is that you get a foreign exchange gain in the first year, and you get a foreign exchange gain in the second year as well. Now, I'm typically looking at the treatment in the second year. So what did you do in the first year? You gave a credit to the profit and loss account. What do you do in the second year? If there is a gain, a foreign exchange gain, it's going to be given a credit in the profit and loss account. So if the company gets a gain in year one, it goes in the P&L. You get a gain in the second year, it again goes in the P&L. Permutation combination number two. You get a foreign exchange loss in year one. You get a foreign exchange loss in year two as well. So what do? You apply the concept of lower of the two, which we've understood, and you decide what is to be taken as a part of the borrowing cost and what is to be debited to P&L. So you'll compare the lower of the two, the actual loss, the interest differential, and you'll decide what is a part of the borrowing cost definition and what is going to be debited to the P&L. Number three. Let's say, for example, you get a foreign exchange loss in year one and you get a foreign exchange gain in year two. This is what the standard is addressing. This is what the standard is addressing in the clause number two, that you got a foreign exchange loss in year one and you got a foreign exchange gain in year two. Now see, watch this carefully. When you got a foreign exchange loss in the year one, you decided the lower of the two and you decided what is a part of the borrowing cost definition. Now, in the second year, if you get a foreign exchange gain, you cannot credit the P&L. You cannot credit the P&L. When you get a foreign exchange gain in year one, you took it to the P&L. But if you got a loss in year one and you get a gain in year two, you cannot take a credit to the P&L. This gain, to the extent of the previous loss, I repeat, this gain to the extent of the previous loss is going to be treated as negative borrowing cost. So for example, in year number one, you decided that an amount of, let's say, 25,000 is included as a part of the borrowing cost definition. The company, let's say, got an exchange loss and they decided that 25,000 is a part of the foreign exchange loss, is a part of the borrowing cost definition. Next year, let's say you get a gain of 32,000. Next year, you get a gain of 32. Now, what do you need to do? You took 25,000 as a part of the borrowing cost definition in the previous year. So out of this 32,000, 25,000 will be reduced from the borrowing cost in year two. So you mean to say that you're going to reduce the borrowing cost definition, you're going to reduce the amount of borrowing cost in the second year? Yes. Just like I'm adding the exchange difference to the borrowing cost, I'm going to reduce that exchange gain from the borrowing cost. So borrowing the exchange gain to the extent of the exchange loss in the previous year is going to be reduced from the borrowing cost definition, and the remaining 7,000 is going to be credited to the profit and loss account. Let me put this again. So you need to be careful that if you're sitting in the second year, it is very important to find out what happened in year one. I repeat, if you're sitting in the second year, it is very important to find out what happened in year one. If there is a gain in year one, and again there is a gain, both will be taken to the P&L. No complications. If there is a loss in year one and if there is a loss in year two, then also the same treatment will apply. You'll calculate the lower of the two and we're done. But the situation where you got a loss in the previous year and you're going to get gain in the next year, now you need to be careful. You need to consider that what was the exchange loss which was included in the borrowing cost in the previous year. The gain to the extent of the loss, is going to be reduced from the borrowing cost in the second year. Whatever excess exchange gain is there, that will be taken to the credit of P&L. Now you would say, sir, there is another fourth permutation combination which is coming to the mind. You would say, sir, I got a foreign exchange gain in the year one and I got a foreign exchange loss in the year two, which is a reverse of the third situation. Now, you would say that this foreign exchange gain was supposed to be credited to the profit and loss account. Now, so what do we do with this foreign exchange loss? Are we going to debit the P&L to the extent of the exchange gain earlier? Well, let me tell you, this is a gray area where the Ind AS is silent. The Ind AS is silent on this particular issue. It doesn't tell you anything on this area. There are four permutation combinations which could arise, and there is no. But if you look at the industry opinion, I think we'll go to accounting policy choice. There is two kinds of opinions. One is called a discrete approach, and one is called a cumulative approach. And based on the industry opinions, in the case number 4, one could take an analogy. One could take an analogy based on the point number 3, that if in the point number 3, you are saying that the exchange loss was capitalized, the exchange gain should be decapitalized. Mind the words carefully. If you're saying in situation number 3, you capitalize something in the first year, decapitalize in the second year, I think I go with the same logic. If I get a loss again in the first year followed by a loss in the next year, I would say, technically speaking, this exchange loss to the extent of the gain should be debited to the P&L, and the rest, lower of the two, should be capitalized. But some people also have reasons to believe that they don't want to apply that analogy and they want to go for the lower of the two. But Ind AS is completely silent on this particular area, so we're not talking of that. So, moral of the story, what we're now discussing in terms of the borrowing cost is, there are going to be two situations you need to be careful on. When you're looking at an exchange gain or loss, there are two situations you need to be careful on. Is the question giving you information for year one, or is it giving you information for a subsequent year? If the question is giving you information for year one, then the logic is pretty clear. If there is a foreign exchange gain, profit and loss credit. If there is a foreign exchange loss, you calculate the lower of the two. And if you're looking at the subsequent year, you need to be careful. You need to see what kind of permutation combinations are arising. When you're sitting in the second year, you need to see what happened in year one. If it is a gain, no problem. You take a credit to the P&L in second year. If it is a loss, no problem. You can simply apply lower of the two. But if it is supposed to be a loss in year one and a gain in year two, careful. In this particular case, what you need to do, you need to see, okay, what did you capitalize last year? And now, in this particular case, the gain to the extent of the previous loss is going to be reduced from the borrowing cost, is going to be reduced from the cost of the qualifying asset. And any excess is going to be taken to the P&L. Challenge could increase further if there have been some repayments of the loan. Wow. I think let's do a little complication with you at this particular end. Okay, Viraj tells me, so thank you for the clarity of the foreign exchange gain or loss for year one and subsequent years. You're most welcome. Koshki, so we'll only see just one previous year or we'll go beyond 1 year as well. Technically speaking, subsequent years would mean second year, third year, fourth year and on. But I guess from the examination point of view, things may not become very complicated for you. So I think subsequent year for your examination perspective could be restricted to second year, but technically it is not restricted to second year. You need to look at the entire cumulative effect. So there could be a foreign exchange loss in year one, gain in second year, gain in third year, gain in fourth year. So we'll have to look at the gains, compare it with the losses of year one. So it could become complicated, but I think from the examination perspective, we're not looking at that. But I think let's take a simple example further, because there is one more point what we need to appreciate in this particular case. So let's take a small example, year one, and let's take an example, year number two. Now watch this carefully. This is a very important agenda where you see an illustration also devoted in the study. Now let's say in the year one, you got a foreign exchange loss. And the foreign exchange loss was, let's say, to the extent of 30,000. And let's say out of this 30,000, what is eligible for capitalization? What is eligible for capitalization is, let's say, to the extent of 25,000. And what was not eligible for capitalization was 5,000, which was debited to profit and loss account. So this is the status you applied in year one. You took a foreign exchange loss and you decided that 25 is eligible for capitalization and 5,000 is not eligible for capitalization. In the second year, I got a foreign exchange gain. And let's say my foreign exchange gain is to the extent of, let's say, 18,000. But in between, also let me tell you that at the beginning of the second year, 60% of the loan was outstanding, 40% was paid off. At the beginning of the second year, maybe you can say at the beginning of the second year, 40% loan is paid off, 60% loan is outstanding. Now, my question to you, friends, when you're going to compare this 18, are you going to compare this 18 with 25? Or are you going to compare this with 60% of 25? You can apply your logics and tell me the answer. So when you're going to compare this 18,000, your comparability is going to be with which figure? You're going to compare this with the figure of 25,000, which was capitalized last year. Or are you going to consider 60% because only 60% is outstanding? So what do you say? Think on a logical front and decide. Just watch this carefully. The exchange loss in year one was on the full amount of the loan, and the exchange gain in the second year is only on that 60% loan, which is outstanding, because 40% loan has been repaid. So are you going to compare this 18 versus 25, or are you going to compare 60% of 25? And I think that's right. So it makes complete sense. That's right. Rashmi, makes complete sense. So I will take 25,000 into 60% because we need to bring them at a comparable base. So we will say 15,000 is the exchange loss, which was capitalized previously. So my answer in this particular case would be that out of this 18,000, 15,000 is going to be reduced from the borrowing cost. And you can say the remaining 3,000 is going to be credited to the profit and loss account. So what you need to do when you make a comparisons, you need to also make a comparison considering the repayments as well. I know what you must be thinking, sir, if the repayment is made in between the years, I think I'm not getting into all that. Things can become very complicated indeed, but I think I don't want to get into all that. On a very safe front, what I've done, I've taken the repayments at the beginning of the year. Otherwise, it could lead to some very interesting permutation combinations. I think we'll end up doing a PhD on the foreign exchange gain or loss. So I think let me just quickly summarize the inputs to you at this particular end. So moral of the story in terms of the exchange gain or loss goes something like this. If it is year one, I think the life is simple. If you tell me that there is a foreign exchange gain, I'll say credit the profit and loss, thank you. I'll say if there is a foreign exchange loss in year number one, I will say please decide the lower of the two, the actual loss or the interest differential, whichever is less, and you get the benefit of capitalization to the extent of lower of the two. You tell me that we are sitting in the subsequent year number two, I'll say, okay, be careful. So you say a gain in the first year followed by a gain. I said, no problem. You said there is a loss in year one followed by a loss in year two. I said, no problem. You said there was a loss in the first year and then again. I said, be careful. I said, be careful. I said, you need to consider that what is the loss capitalized last year, and first consider if there are any repayments or not. So calculate the exchange loss on the unpaid loan and then compare it with the exchange gain and then decide. Now, if you tell me, so there was a gain in the last year and a loss in the current year, in the subsequent year, I'll say the Ind AS is silent. So I think this is going to be, judgmental. And I don't think so we're going to get this in the examination because this could lead to judgments. So the only complication in a subsequent year would arise when there is a loss and then there is a gain in the next year. Right, friends? I hope I am pretty clear with the concepts to you on this. Right. Okay, so far so good. I think my 7 terms are done. And I think now first give you a break, I guess. You'll need one. Then I think we'll start discussing the accounting treatment and certain related issues. I'm left with 2 areas of discussions with you. One is in terms of the accounting treatment, and one is with reference to the concept of commencement, suspensions, and cessation, the period during which a capitalizations will be allowed, which is a pretty simple concept. I think having understood the larger concept, it's not going to be a big challenge in terms of things. Okay, so I think we'll give you a 10-12 minutes break at this moment, and then we commence back with the remaining agendas in the standard. So let's give you a break, friends, at this. Okay, I think clear, wonderful. Viraj, you said depreciation impacts if borrowing cost is changed. Yes, the moment, but you see, depreciation would not have started, unless and until the asset was ready for use. So this status is all going on before the depreciation begins, right? Right, friends. So I think let's give you a break now, and we'll start back in 12 minutes time with you. Break लगा दीजिए। Welcome back, friends. So I hope you have got your mind relaxed in the break as well. So I think now let's take it further. I think now we've understood all these 7 terms which I had elaborated to you during the course of my summary which I made. And I would say, maybe if we get time in the end, we'll revisit on that summary once again. But I think now we need to be very clear in terms of the 7 terms which I gave you, that what is important is that there has to be a debt. And what is important is that you're incurring a borrowing cost, which is 3 cases we've seen. Either it is a case of interest on a functional currency, or it is a case of interest on a foreign currency loan with an exchange gain or loss and the nitty-gritties, or it is a case of an indirect loan where you've taken an asset on a lease. Number 3, it is something which is directly attributable, unavoidable, and this is related to acquisition, construction, production of a qualifying asset which has got the main parameters that it is not ready for intended use or sale, and it would generally take a period of 12 months or more to get ready for the purpose. And there is a cutoff date which is ready for use, and we are looking at the amount of eligibility. So this standard is not the final authority, but the measurement principles governing the qualifying assets would, technically decide the status. Okay, now I think let's take it further. And now I'm going to come to the aspect in terms of the accounting treatment with you. I think, Kaushik, you've got a question. Exchange loss is on account for increased payment of interest or increased payment of the principal. Well, we are calculating the exchange gain or loss on the outstanding principal, because when you've taken the interest is already been taken at a closing rate. So you can say the interest element is already taken care, you can say indirectly, of the exchange loss on the interest element. So the exchange loss is going to be calculated only on the outstanding principal. So I guess that answers your question. We're going to consider only the outstanding principal, and we're going to calculate the gain loss on that particular amount. Okay. Now let's, I think, take it further. And I'm going to the next phase of the standard, and that is the accounting treatment. And this accounting treatment is absolutely similar what you've done in accounting standard 16 as well. There is no difference in terms of what I'm about to tell you right now and what you've done in terms of AS 16. The standard Ind AS 23 categorizes that the borrowings are of 2 categories. So we can actually segregate the borrowings of the entity into 2 categories. One is what we call specific borrowings, and one is what we call journal borrowings. So there are 2 kinds of borrowings. One is called a specific borrowings and one is called a journal borrowing. Now, the company may take a specific loan for a specific qualifying asset. You take a specific loan for a particular specific qualifying asset, then it becomes a case of a specific borrowing. But sometimes what the company would do, they will create a general pool of funds. So they would borrow money from, let's say, 2-3 sources, and they may create a construction of, different qualifying assets out of the general pool of funds. So we cannot really decide, which particular fund is being used for which particular asset in that particular case. So let's have a look at what is the accounting treatment when it is a specific borrowing, and what is the accounting treatment if it is a general pool of funds. Well, if there is a specific borrowing, the standard says that the amount which is eligible for capitalization is supposed to be the actual borrowing cost. It is supposed to be the actual borrowing cost minus what we call income from temporary investment of borrowings. Income from temporary investment of borrowings. Now, let me explain what is that temporary investment from borrowings. Now, there is a possibility that the company has borrowed a specific fund, but the construction is yet to begin. The expenditure is yet to be incurred. So what the company did in this particular case, they invested this money in some securities and they started getting an interest income. So the standard says that when you're going to capitalize the amount of borrowing cost, it is the net cost which you can capitalize in this particular case. So you've incurred an actual borrowing cost, that's one, minus the income which you're getting from temporary investment. So if you park that money on a temporary basis, then you get a capitalization. Nobody will go to see very soon see a practical illustration on this part. Now, when it comes to a journal pool of funds, then I would say that you should follow a simple step-by-step procedure. And I would say that we can apply a three-step model in this particular case. So what you can do in the journal pool is step number one. In step number one, we're going to calculate what we call a capitalization rate. In step number one, we're going to calculate what we technically call a capitalization rate. Well, if you ask me, a capitalization rate is nothing but it's a weighted average cost of borrowing. So you create a pool of funds and each borrowing is taken at a different rate of interest. So you just need to get a weighted average rate. That's it. So the capitalization rate is nothing, but you can say it's a weighted average of the journal pool. So it's a weighted average of the journal borrowings. Remember, when you calculate a capitalization rate, we're not going to consider any borrowing cost which is paid on a specific borrowing. We just need to consider that, whatever journal pool of funds you've created, so what is the amount of, weighted average rate out of the journal pool of funds? How do we calculate that? We'll see. Then there is a step number two. Once you've calculated a capitalization rate, you go to the step number two. Now, at times, students get a little confused in terms of, sir, when I take the step number one, am I supposed to consider the date when the capitalization begins? Am I going to consider the date when the capitalization ceases? No. Your calculation of the capitalization rate is only going to be a rate for a given year. It does not consider anything, when you started a capitalization. It does not consider anything in terms of when you cease or you suspend your capitalization, though we're going to talk of that a little later. But in any way, to clarify that step number one is basically a weighted average rate. I'm only concerned with the date when the money is borrowed. I'm only concerned with the date when the money is repaid. I'm not concerned with when the capitalization begins or when the capitalization is seized. It's simply a weighted average of the borrowings. That's it. Then we come to the step number two. And what do we do in terms of step number two is we're going to multiply. We're going to multiply the expenditure which you have incurred on a qualifying asset. Mind you, it's the expenditure. It is the expenditure which you've incurred on the qualifying asset, and this will be multiplied with the capitalization rate which you've computed in step one. Now, there will be something more which we need to do in step number two, which I'll discuss later. But for the time being, let's consider that we'll consider the expenditure and multiply this with the capitalization rate. And this is going to give me the amount which is eligible for capitalization. Then there is a step number three also, which needs to be applied. And generally, you'll not see that, the status of this step is done in most of the questions. So generally, we end the journey in step two, but then there is a third step also, which technically the standard requires. And the third step is something what we can technically say is a cross-check. The third step is basically what we call a cross-check. And this cross-check is that you need to compare. You need to compare that whatever amount you've computed in step number two, whatever amount is eligible in step number two, we need to ensure that it is less than or equal to the actual borrowing cost incurred. It has to be within the actual borrowing cost which is incurred, because the company cannot get the benefit of overcapitalization. So we need to ensure in step three that if the company is capitalizing a certain amount, the amount capitalized should not exceed, the amount eligible should not exceed the actual borrowing cost. Now, you would say, so why would that happen? Why would the amount of eligible amount exceed the amount of borrowing cost in this particular case? I'll give you a very simple logic for that. When in step number two, you are considering an expenditure. The expenditure might have been incurred out of, let's say, the own funds of the company, or the expenditure might have been incurred out of the loan funds of the company. Because you borrowed a certain pool. So let's say you borrowed a total of, let's say, 600 lakhs. Then you're going to incur a borrowing cost on 600 lakhs only. But when it comes to spending on the qualifying asset, the company might have spent, let's say, a total of 1,000 lakhs out of, own and loan funds both. So when you go to apply the capitalization rate to the expenditure, and the expenditure is the total expenditure, irrespective out of which funds it has been incurred. So there is a possibility that the amount in step 2 could exceed the amount of actual borrowing cost incurred. Because in this case, you would have incurred the borrowing cost on 600 lakhs, but the expenditure incurred is 1000 lakh. So 400 lakh has been spent out of own funds. So the amount which you're going to get in step 2 would exceed the actual borrowing cost. So therefore, a step number 3 is required. Though I've not seen many a times we're applying a step number 3, we generally end at a step number 2. But technically speaking, we need to apply a 3-step model. So when you see a journal pool of funds, you need to get a weighted average rate. That's one. You need to apply the expenditure into the rate and then see a check. I think let's do one thing. Let's, I think, take 2 illustrations. One is maybe on a journal pool of funds along with a specific one, and one is purely which is related to a specific pool. So let me just go back to the study material, and I think let's pick up a question with you on this. So coming back to the study material, we've done illustration 5. So I think let's have a look at the illustration number 6 with you. It says Alpha on 1st April X1 borrowed 9% 30 lakhs to finance the construction of 2 qualifying assets. Well, don't be under an impression that if a company borrows a funds for 2 qualifying assets, it would be a journal pool of funds. Because many times people feel, okay, I've taken a loan, and if it is for a particular single asset, then it is supposed to be a specific fund. Not necessary. The company could take a single loan, let's say for 2 or 3 qualifying assets as well, and fund each of those assets with a specific loan. So in this particular case, the company borrowed a 30 lakh rupees to finance the construction of 2 qualifying assets. And the construction started on the same date when you borrowed the funds. The loan is availed on 1st April X1, and it says the remaining funds have been invested temporarily at 7%. Now, see the sum total of what you spent. The company has spent 5 lakhs on the building of a factory building and another 10 lakh on the office building on 1st April X1. And the company has spent another 5 lakhs on the factory building and another 10 lakh on the office building on 1st October X1. If you take the sum total of all the expenditure on the buildings, factory and office put together, it is equal to 30 lakh. So I think this definitely proves that the company has taken a specific loan, and this specific loan has been taken for 2 qualifying assets. One is a factory building and one is an office building. Now, when the company took this loan of 30 lakh rupees, not the entire money was spent. As per the information given on 1st April X1, we've spent 5 lakhs on the factory building and 10 lakh on the office building. So another 15 lakh rupees was still pending with us. So I think let's do one thing. I think before I just work out the calculation, let me just do a little workings with you first of all. So what we can do in order to solve this question easily, this is the illustration number 6. So I think it's important to first organize the data in order to make some easier calculations out of this. So we can first of all make a mention to the examiner as well that this is a case of a specific borrowing. So I am considering that this is a case of specific borrowing. The company has taken, you can say, one common loan for 2 assets. So the company has got a 9% loan. So we can say the company has taken a 9% loan, and this is for 30 lakh rupees. And we can segregate that this is meant for 2 qualifying assets. One is supposed to be a factory building, and one is supposed to be an office building. So they've taken a common loan. You can say there is a specific loan for 2 assets. So for the factory building, the loan taken is for 10 lakhs. And for the office building, the loan taken is 20 lakhs. So I think this will prove that it is a specific money. So you've taken one loan for 2 assets. It is still specific in nature. Okay, now let's see what is the amount which is eligible for capitalization. Now, in this particular case, what is the actual borrowing cost in this particular case? Now, if you consider what is the actual borrowing cost in this particular case, I would say, what is the actual borrowing cost? The company has taken a loan of 10 lakh at the rate of 9%. So what is the actual borrowing cost is 90,000. And what is the actual borrowing cost on the other loan? We can say the loan is for 20 lakhs and you paid a 9% interest. It comes to 1 lakh 80. So this is what actual borrowing cost, as you can see out here. So the borrowing cost which is taken is the actual borrowing cost. Now from this, you need to reduce the income from temporary investment. The company spent 5 lakh rupees on 1st April. So remaining 5 lakhs is available and it was invested till 1st October. That means for 6 months. And you've invested that money at the rate of 7%. So the company is able to invest that surplus money, which was not incurred on 1st April, and that is invested at 7% for 6 months, that is up to 1st October. Here also, in the second case, in terms of the office building, the company is invested that surplus money of 10 lakh rupee at the rate of 7%, and this is again invested for 6 months till 1st October. So you'll be able to get the net figures, and these net figures are supposed to be the amount which is eligible for capitalization. Very simple and very straight indeed. So now I think you can watch the answer as well. So we've taken the borrowing cost, which is on the total amount borrowed, 10 lakhs for the factory and 20 lakh for the office building. And then we've taken a reduction in terms of the temporary investment income, which you've earned for 6 months. Simple and straight. Okay, so that was illustration number 6. Now I think let's take you to another illustration, and where we can look at a journal pool of funds as well. So let's have a look at the illustration number 8, which is dealing with a journal pool of funds. Okay, I think a question I think Sunat has got, journal borrowing means purpose is not specified in that particular case. Okay, so yes, you can say that. But having said that, let me also tell you that the company is, yes, the company is created a pool of funds, which could include, funds for which you have not defined that this is meant for this asset. So the company takes, let's say, 3 different categories of loans, and you are basically spending that money on the construction of, let's say, 4, 5 qualifying assets, whatever. Like, for example, if you look at the illustration 8, I think that will make the position a little more clear. It says in illustration 8, Beta had the following loans in place, and that is on March X2. Now you can see they've taken an 18% bank loan, which was there on 1st April X1 and there on 31st March X2. So there has been no repayment in between. Then there is a 16% term loan, which is there at the beginning of the year and at the end of the year. So it's been outstanding for the full year. There has been no repayments in between. Then there is a 14% debenture, and you can see it's not there on 1st April, but it's there on 2000. That means it's taken somewhere in between. It says 14% debenture was issued to fund the construction of the office building. Is that a specific borrowing in this case? You've taken an 18% bank loan, you never said anything. You've taken a 16% term loan, he never said anything. And in terms of debenture, he's very clearly telling you that the company has taken this for office building construction on 1st July, and this is supposed to be specific in nature. Then he says on 1st April, Beta began the construction of a plant being a qualifying asset using the existing borrowings. The expenditure drawn on the construction is 5 lakh incurred on 1st April X1, and it says another 25 lakhs incurred on 1st January X2. So you spend this money on different dates on the construction of the plant. So there is a building for which we have taken a specific loan, and there is supposed to be, you can say, a plant for which we have created a journal pool of funds, the bank loans and the term loans. Now calculate the borrowing cost to be capitalized for the plant. He's talking about the plant, he's not talking about the building. So I think let's concentrate only on the plant. So let's go to the plant in this particular case. So let's, I think, solve this illustration number 8. Now, I'm going to apply the steps which I give you in this particular case. So I would say my step number 1 is related to the calculation of the capitalization rate. Now, when you're looking at a capitalization rate, am I concerned with the date when the construction begins? No. Am I concerned with the date when the construction ceases? No. Am I concerned with the money is borrowed? Yes. Am I concerned with the date when the money is been repaid in between? Yes. It's an annual rate. It's an annual rate. So let's, I think, pick up the information. You've got 18% bank loan journal pool. You've got 16% term loan journal pool, but you've got a 14% debenture. It's not a part of the journal pool. I'll not take that as a part of the capitalization rate. So we can say, what is the borrowing cost you incurred? You incurred on 1,000 lakhs and interest at the rate of 18%. This is the borrowing cost on one pool. You've also incurred on 3,000 rupees a 16% interest, and you're paying this interest for the entire year. These two loans have been outstanding for the full year. So this is the borrowing cost on the journal borrowings. This is the borrowing cost on the journal borrowings, and the entire 1,000 and the entire 3,000 outstanding for the entire 12 months. Indirectly, we can say that when you're calculating a capitalization rate, we are indirectly saying you need to consider the borrowing cost on journal borrowings divided by the weighted average of journal borrowings outstanding during the period. So this is, we can say, can be used as a formula in order to calculate a capitalization rate. The company would consider on the numerator whatever is the borrowing cost on a journal borrowings divided by a weighted average of the journal pool. In this case, both the loans have been outstanding for the entire 12 months. So we've taken 1,000 and 3,000. Let's see what is the capitalization rate. So we can say 180 plus another 480 divided by 4,000. This is coming to 16.5% is the capitalization rate. Simple and straight indeed. Now we go to the step number 2. Now we go to the step number 2. And what do we need to do in step number 2? You need to multiply the expenditure which you've incurred on the qualifying asset and multiply this with the capitalization rate. Now, I think it's time to tell you something which I'll discuss very shortly. Technically speaking, I am also required to apply a period out here as well. When you're applying the step number 2, you're also required to apply a period out here. Now the question rises, which period am I making a mention in this particular case? Now let me clarify in this stage. When I'm looking at the period in step number 2, this is a period you can say which I called CC. This is a period which I called CC. So when you're considering the step number 2, you need to consider the expenditure into the capitalization rate into the period. And the CC is what I call the period from commencement, when the capitalization will commence, and it is going to end on the date of cessation, when it is going to end. Your capitalization will be done for the block when the capitalization starts and when the capitalization ends. So we need to consider the date which I call CC. Now, I think let's see what is the case in this case. We're looking at a plant, and I think in terms of the plant, let's look at the data. The company has incurred a total of 5 lakhs on 1st April X1. The commencement date is 1st April X1. Then the company incurred another expenditure 25 lakhs on January X2. So what are we going to consider? Cessation date is not given. So I presume that the commencement still continues. So on this 5 lakh rupees expenditure, you apply the capitalization rate. And since it was incurred on 1st April X1, the period is entire 12 months. Then the company incurred another 25 lakh rupees and the capitalization rate annual is 16.5. And what is the period you need to consider? This money was incurred on 1st January. So you need to consider January to March. That is a period of 3 months. So this is important that when you apply the step number 2, you also need to consider the period. The period will be the commencement date. In this particular case, commencement date is when you incur expenditure. In the 5 lakh was incurred at the beginning, but 25 lakh was incurred on the 1st of Jan. So it will be commencement date up to the date of cessation or up to the year end, whatever is applicable. So this is the amount which is going to be eligible as per step number 2. So I think if we calculate on 5 lakh, 16.5%, that is coming to, I guess, 5 lakh into 16.5 is 82,500. And if I calculate on 25 lakhs, we take a 16.5% for 3 months. That is 103,125. So you can say the sum total of this is eligible for capitalization. That's 185,625. Ideally speaking, we could also compare this with the actual borrowing cost, but generally I've not seen that being applied. So you can see the answer is very clear, simple and straight. The borrowing cost is 185,625, which is eligible. And there are two techniques with the help of which the answer has been given, but both the answers are same. So I've given you one of the techniques in how you're going to calculate a capitalization rate, and then you apply the rate into the expenditure and the period, which we call CC. Oh, friends, I am pretty clear on the accounting part so far with you. Okay, now I think let's take it further. So this is one part of the discussion, that is the accounting treatment. Now I need to take it a little further, and we need to do a little discussion on that CC part with you. Because if you're looking at the accounting, and specifically when you're looking at the step number 2, you're looking at the commencement, you're looking at the cessation. In a practical illustration, I think these dates might be very clearly given. But there could be, a little independent questions also coming on the commencement, on the cessation. So now my third phase begins. Let me tell you, I have divided the standard into 3 phases. At the first phase, I did a discussion of the 7 terms with you. In the second phase of my discussion, I did the accounting treatment discussion with you, wherein we discussed the treatment of journal and specific proof. The third phase of discussion is what I call CC, commencement, cessation, and along with this, I'm also going to discuss the concept of suspension. Okay, so I think let's begin the journey. Now, I'm going to first of all discuss one by one on these areas, but I think before that, let's first give you a time scale in order to understand the picture. Capitalization begins what we call from the commencement date. Capitalization starts at a date what we call the commencement date. Capitalization ends at a date what we call cessation date. And there could be a rough patch in between. And this is the period when the capitalization will be temporarily suspended. It is called suspension. So now we're going to discuss 3 areas with you. One is the area of commencement, and one is the area of suspension, and one is cessation. So in simple words, you can say when you're looking at commencement, commencement means when do you begin capitalization? And cessation means when do you end the capitalization? And suspension means that there is a temporary full stop to the capitalization. You're telling the company that you cannot capitalize for this particular block. So I think let's first talk about commencement. Then we're going to talk about the concept of suspension in a little more detail, and then about the concept of cessation, because there was a beautiful question I remember which came a long time back in Accounting Standard 16 that was in CA Final in 2001. And that was a brilliant question, I think, which I'm going to give you the essence of that question, because I think that kind of concept could be equally applicable to Ind AS 23 as well. Let's, begin with, first of all, the commencement part with you. Now, coming back to the study material once again with you on the commencement part. Now, if you read what is given on the commencement, it says entity is required to begin the capitalization as a part of the cost of the qualifying asset on the commencement date. The commencement date is the date when the entity first meets all the following conditions. I think let's not read ABC, but ask you a basic question. It says commencement date is when you meet A, B, and C. So do you think it should be the earlier of the 3 dates? Or do you think it should be the later of the 3 dates? You need to ensure the date when all conditions are met. So if the conditions are met on different dates, are you going to consider the earliest of the 3, or are you going to consider the later of the 3 dates? What do you think on a logical front? Okay, Koshki said cessation means earlier or when the asset gets ready for use. Yes. Okay, I think Rashmi said, what about the step number 3 on illustration number 8? Well, I have intentionally not discussed the step number 3 because, technically speaking, there is going to be a mathematical, incompatibility in terms of doing the check. If I just take you back, and I think if I just like to, have a look at my step number 3, let me ask you something. Can I say in this particular case, is this the amount of borrowing cost incurred? If you look at the step number 1 of illustration 8, is this 480, which you've calculated 180 plus 480, I guess 180 plus 480, is this sum total of 660 the actual borrowing cost which is incurred? I would say yes. And what is the amount you're trying to capitalize in this particular case? It is 185,625. That 660, to remind you, is in terms of 1,000. So can we say in this particular case, the amount of actual borrowing cost is much more than the figure computed in step 2? But if I ask you, do you think they are really comparable? If you technically ask me, I think the comparability doesn't arise. Because when you're looking at the actual borrowing cost, it's a borrowing cost which is incurred for the entire year. And when you're looking at the amount computed in step number 2, it's considered a period as well. So I think I didn't want to intentionally, get into that mode of discussion with you, but I think you would have understood my point as well, that when you're looking at the actual borrowing cost computed in step 1, it ignores the concept of the period, because only considers the period of, when you took the loan, when you repaid the loan. But your step number 2, when it takes a eligibility portion, you're considering the commencement and the cessation date. So mathematically, they are not technically on a comparable mode. So I think maybe from the examination point of view, it's always been avoided. I'm pretty sure even at the intermediate level, you would have never made that cross check, I guess. Am I right? Right. So I think we got the answer. So is it fine to leave the step number 3? I would say yes. Okay, that's right, Lee said. So when you're looking at the commencement date is going to be the later of the 3 dates. Now let's have a look at what are these 3 dates all about. The first is that you incur the expenditure. The second is you incur the borrowing cost. And the third is you undertake the activities which are necessary to prepare the asset for intended use or sale. Now there has been some clarifications which are given in the standard, especially when you say that there are activities which are being undertaken. Well, in point number C, many at times, we tend to believe that activities would mean a physical construction. But I think, let me clarify that activities is not necessarily means a physical construction. Activities would technically mean that there is some kind of work which is going on, even if it is, let's say, obtaining permissions from the appropriate authorities. Even though the physical construction is not yet started, it would still be construed that activities are in progress. So any kind of work which a company is doing, even if it is obtaining permissions, as I said, it will be considered that activities necessary have started. So what we need to do, we need to make a list of 3 dates. When did you start incurring an expenditure? When did you start incurring a borrowing cost? And what is the date when the activity started? And you take the latest of the 3 dates. Okay, so moral of the story is very clear. So I think if I go to the concept of commencement, we can say the commencement is the later of 3 dates. It is the later of the 3 dates. So what do you need to do? You just need to make a list of 3 dates. The date when the borrowing cost is incurred. You need to consider the date when the expenditure is incurred. And you need to consider when the activity started. So when the activity started, just take a list of these dates and you can consider. Let's take a practical illustration on this. So there is a small illustration which is given in the study mat on illustration number 9. And we've given some information. Let's, I think, have a look at which are these 3 dates. It says X is commencing a new construction project, which is to be financed by borrowing. And the key details are given. I'll just read up the dates and you will help me not in the commencement date, but you'll help me in terms of those 3 dates. 15th May X1, the loan interest starts to be incurred. So can I say 15th May X1 is the date when the borrowing cost is getting incurred. Next, it says on 2nd June, the technical site planning commences. and 18th July, the construction work begins. The physical construction started on 18th July, but the technical site planning started on 2nd June. So can you tell me, when did the activities begin? Are they going to begin on 2nd of June, or are they going to begin on 18th of July? So what do you say in this particular case? When you're considering in this case, the physical construction started on 18th July, but the other activities started on 2nd June. So which date are you going to consider, 2nd June or 18th July? And that's rightly said. We're going to consider 2nd of June when the activities started. And then finally, I am given the expenditure was incurred on 19th June. So you incurred the expenditure on 19th June. So you take the latest of the date. So we can say the date of commencement is supposed to be 19th of June. Simple and straight indeed. Okay, so this was on the commencement part. Now, if we go to the next agenda, that is suspension. If you look at the concept of suspension, I would just like to read something to you. And in this particular case, I have a little thought processes on the suspension. And I think, let me just read something and ask you. I think I'd like to spend another 5-7 minutes on the suspension part, because this is something really very close to my heart. And I think I'd like to spend time and give you a clarity as well, though I think this is a very small portion. And I don't know how much it could impact the exam. So allow me to do a little more deeper analysis on suspension. Let me, I think, first of all, read something. It says capitalization of borrowing cost shall be suspended during extended period in which the active development of the asset is suspended. So it's very clear that capitalization should be suspended when the active development is suspended, which means if the development is not taking place, the capitalization advantage should be taken away from the company on a temporary basis. It says such cost is a cost of holding partially completed assets, and they do not qualify for capitalization. So the work was going on when the work came to a standstill. So during that particular point of time, even though the company is incurring a borrowing cost, but we will say that since the work is on a hold, the capitalization advantages should not be given to you. Then the full inputs given is that capitalization is not suspended when a temporary delay is a necessary part of the process of getting the asset ready for intended use or sale. So sometimes we can say that it is something which is unavoidable in nature. So the delay is something which is unavoidable. It says, for example, a capitalization continues during extended periods when high water levels delay the construction of a bridge, if such high water levels are common in the geographic region involved. Now, I think based on what I just read, I think let me ask you a small little question, and I think you can maybe help me giving an answer. This is based on the facts which came in the exams in May 2001. I'm talking of the old course which was there in the CA final. That was in May 2001. A beautiful question came on accounting standard 16. So I'm giving you the question which came on AS 16, but I think the language of the standard on Ind AS 23 and AS 16 on the suspension parameters is 100% same. So I think the guidance which we can draw from that particular question can be very interesting indeed. So I'm going to put across a question now based on what we read. Just tell me. In this particular question, what the examiner did, they gave us information from January to December. And they gave us a monthly expenditure, and they gave us a column for a planned expenditure, and they gave us a column for an actual expenditure. So what the question gave in the exam, they gave us information on a month-wise expenditure. They gave us an expenditure which was planned every month, and they gave us an expenditure which was incurred every month. But in between, during the period of June, they said that there was a strike. In between, they said that there was a strike, and they said the work came to a standstill during a period of strike. So now the question arises that if the company had a strike in the month of June, due to which the active development came to a standstill, do you think capitalization should be suspended or not? Your inputs. I think let me give you the facts once again, and let's get your inputs on that. So the facts which were given in the question were very interesting. The company had given us a data of a monthly expenditure, which was January to December. But interestingly, they gave us two columns. One was a planned expenditure column, and one was an actual expenditure column. And then in the month of June, it was given in the question that there was a strike. And due to strike, it was very clearly given that the active development got interrupted and the work could not take place in the month of June. So the question now arises that do we continue with the capitalization in June, or do we suspend the capitalization in the month of June? I think let's get your inputs. Okay, I think I'm getting some inputs. I think Sumit tells me no, since not necessary for active development of the qualifying asset, but the work came to a standstill. Okay, Kaushik, you tell me, can say unavoidable, so capitalization will not suspend, but strike is something which could have been avoided. You could have maintained some good human relations with the people, and the strike could have been perhaps avoided in nature, no? Okay, now, I think I'd like to give you the answer first, and then I'll give you the logic. In fact, when the suggested answer came, before the suggested answer, many people had the opinion, and they said, that strike is something which is going to be avoidable in nature, and the capitalization should be suspended. But in the suggested, it was very clearly mentioned that during this period of strike, the capitalization will continue. Let me now tell you something. And do tell me very carefully, did you think about that or not? I'll need a very truthful answer at your end. Before I give you the answer, let me just take you back on the provisions which are given in the standard. It says capitalization shall be suspended during extended period. During extended period. I always tell people, I will be able to say this in Hindi, because I think we may not get the exact meaning if I put this in English, but I always give an example at this particular stage. It was written on the road, Roko, mat jane do. And there was no comma, there was no full stop. So it was written Roko, mat jane do. And somebody said Roko mat jane do. And trust me, the interpretation completely changes, If you read the word Roko mat jane do, the interpretation is different. And if you said Roko mat jane do, the interpretation is totally different. Now, I would like to draw your attention back again on the word. It says capitalization should be suspended during extended period. During extended period, the focus is on the extension. Can I say the examiner gave me the information about the planned column, and this planned column was indicating that the expected date of completion is December? And when the company gave me the actual expenditure, they actually completed the work in December. Oh, so am I indirectly trying to say that your target date of completion is also a deciding factor? To me, I think yes. I think that seems to be a very good interpretation. If you look at certain examples and illustrations which are given in the education material as well, they are throwing some wonderful light on the concept of suspension. So I think I'd like to give you a conclusion based on the understanding of the illustrations which are given in the education material as well, that what would be the fate of suspension. So I would put it like this. I would say that you should first of all look at the reason of the suspension. I would say that you should first of all look at the reason for the suspension, and we'll get the logic also. Let me first give you the crux, then I'll give you the logic as well, that why I'm saying it should happen like this. Now, I would say the reason could be broadly divided into two categories. Either we say it is something which is unavoidable. Either I would say that it is something which is unavoidable, or I would say the reason is something which is avoidable in nature. Now, I would say if it is avoidable in nature, then you should look at another question and put across that did you meet the target deadline or not? There must be a target deadline to complete the construction. So you should see that did you meet the target deadline or not? If you say, yes, I met the target deadline, then in this particular case, the capitalization should continue in this case. Makes sense. And if the target deadline is not met, you fail to meet a target deadline, then the capitalization should be suspended. Okay, let me now give you the logic as well. I think a suspension of a capitalization is indirectly a penalization to the company. You're telling the company, boss, you're incurring a borrowing cost, but I will not give you the benefit of capitalization. Now, trust me, I got 3 hours to complete. I've got 3 hours to complete your Ind AS 23, and I'm about to get it completed. Maybe in between, I would have walked out of the class and said, I'm taking a longer break, but I still complete all the concepts within the time span. You'll not penalize me for that, right? If I am able to still meet a target deadline, that means in spite of the delay, the company made up for the loss. So if the company has been able to make up for the loss, then I think we should not penalize them. But if it was a reason which was avoidable and due to which the company still could not meet targets, then I think it's time to penalize. Now, if you look at this particular example, you can see the strike is something which is avoidable in nature. Well, we know there are certain factors which are avoidable. Fire is something which is avoidable. You cannot say fire is unavoidable. But if you say there is a flood, I would say it is unavoidable. So if there is a strike, if there is a fire, I would say it's an avoidable reason. But if you say that there has been a flood, for example, it is unavoidable in nature. So I think the first thing we need to see is the reason. So if the reason is something which is avoidable, the company could have avoided it, but in still, met a target deadline, don't penalize the company. So the logic seems to be fairly clear, that we're not penalizing the company because in spite of the fact that the work came to a standstill, they're still able to complete work and there is no extended period. But if the company is not able to meet a deadline, then I think suspension should happen. Now, what happens on an unavoidable reason is also interesting to watch. If you notice in the example which is given in the standard as well, it says, capitalization continues during extended period when high water levels delay the construction of a bridge. Now, there has been a high water level, so this is something which is unavoidable in nature. But it says, if such high water levels are common in the geographic region involved. So which means, if it is unavoidable factor, I'll put across a question that is it something which is common in the geographic region involved or not? Because there is a if which says that I will allow you a capitalization if it is something which is common. So if it is common, then I can give you a benefit of doubt. So if you say, yes, it is common in the geographic region involved, then I think the capitalization benefit should continue, because it is something which you cannot avoid. And anything happens any point of time, nobody knows. But if it is not common in the geographic region involved, who told you to do construction in that phase? Then I think in that case, if there is a stoppage of work, boss, I'm going to make a suspension in this case. So that's what my understanding of the concept of suspension is, based on what is given in the education material and based on what is, came in exams in 2001. So to my mind, the suspension is like a penalty to the company. So I think we should look into the reasoning number one, that if the reason is something which is avoidable in nature, then we should see that did you meet a target deadline or not. I penalize you if you extend. I don't penalize you if you don't extend. And if it is unavoidable reason, then I need to see that it is something which is frequently happening out there, it's common in the region involved, then you continue. There is one example given in the education material where there has been an unavoidable reason and it's not common to the geographic region involved, and the capitalization has been suspended in that particular period. Right. I hope, friends, I've made myself clear. So I thought, I'll just share my viewpoints on that as well. Okay, wonderful indeed. Interesting, very interesting. And okay, Kaushi, please tell common questions response again. Okay, I'll give you the common response again. Now, if you look at the example, what it says capital. This is an example which is given in the Ind AS 23 as well, which says capitalization continues during extended periods. Naturally, your capitalization will get extended if there has been a delay. And it says, if, the word is very clear, if such high water levels are common in the geographic region involved. So that means if the high water levels are not common in the geographic region involved, then I would not have given the benefit of capitalization. And if you want to get a little more clear understanding on that, maybe you can refer one of the questions which is given in the education material. And that very clearly elaborates that. I think maybe I can show you something. I am taking that education material. I think, let me just share, if I can share you a particular question which came on cessation part. Just a second. I think I'll just have to locate that question. If I'm able to locate that question, I think I'll definitely take you further. Yes, here it is. This is the question number 21, which is there in the education material. I'm reading the question 21 of the education material to give you a little more clarity of thought. It says XYZ is engaged in the business of construction and development of shopping malls and leases out shops and spaces in the mall to the customer. It is an ongoing project of construction mall in Calcutta, which it has borrowed 75 crores from a bank to meet the project expenses. The project of construction of mall meets the definition of qualifying asset. We need to give the suggested accounting treatment. I'm looking at the clause number A. The construction was suspended for a period of 10 days on completion of each floor for the concrete to settle. There is a delay of 2 months due to extreme floods in Kerala. I don't know whether it was Kerala or Calcutta because the project is going on in Calcutta. But I think maybe they wanted to say Kerala only. Now tell me one thing, if there has been a flood situation in Kerala, and due to which I say that my Calcutta project is got, suspended. Do you think I'm going to give you the benefit of capitalizations in those particular cases? I say, in Kerala, there has been a flood, and due to which a project in Kolkata is gone on a standstill. Do you think I'm going to give you a benefit of that? Of course not. And I think even if I take this as Calcutta, then I would technically say that it's not common in the geographic region. I think if you say Kerala, there has been, a kind of a, flood situation, which is very common, understandable. It's common in the geographic region involved. So I think if I just take you to the answer, what was given in the accounting standard board, they very clearly said that in the given case, XYZ suspended the active development. It says during the floods which are not in the common area. So they very clearly said that it was not in the common area. So if it is not common in the region involved, capitalization was suspended. So basically what I wanted to give you the input is that the moment the reason is unavoidable, for example, a flood, and you say it's common, I continue. If you say it's not common, then I would suspend, right? I hope you got your answer on that. Okay, somebody said, so what if suspension is necessary to complete the project then? Well, if you say, for example, that you need the concrete to settle down before you go for the construction of the other floor, understandable, it is something which is unavoidable in nature. So in this particular case, the capitalization would continue. So I think any factor which is unavoidable in nature would require a input, that this is something which is common. You cannot go for further construction until the concrete has settled. So you cannot take a plea of a flood, but you can take that, yes, it's a necessary part of the process. I know that once I laid on the floor of a particular building, I need at least a 15 days time to settle down, the concrete to settle, and the construction stops. Pretty understandable. Then it will continue. Okay, now coming to the last phase of the standard, and that is the agenda in terms of cessation. Now, as far as the concept of cessation is concerned, cessation, as we typically said, would be a situation where we're saying, let's the capitalization cease, let it come to an end. And the standard is very clear on the picture. I think, let me just take you to the study material. And we're given some inputs on the cessation. It says capitalization of the borrowing cost should cease when substantially all the activities necessary to prepare the asset are complete. The wordings are very clear. It says when substantially all activities are complete. Now, if you technically ask me, what do you mean by that it is substantially complete? Well, it is judgment. I cannot give you a conclusive definition of what is substantially complete. But the standard has definitely given us guidance that if there is some minor decoration work which is pending, then in those particular cases, we can definitely say that the work is substantially complete. Because if the physical construction is complete and there is some minor work which is pending, then we can always say that it is complete. And the standard has also given us clarifications in terms of a phase construction as well. Let's say, for example, if you're thinking of a lot of buildings being made, like for example, you see societies, and in those societies, you'll see that there is a tower A, there is a tower B, and there is a tower C. So there is a construction which is going on a phase construction. So in this particular case, it is possible that the construction of tower A is complete, but the construction of B and C is still going on. So you will seize the capitalization of the tower A because it is capable of independent use as well. Because if you can say that you might be doing a construction for all the project in entirety, but you can say in a particular project, if the tower A is something which is capable of being sold or used independently, then I will seize the capitalization as soon as the work of that particular tower is done. That clarification is also given in the standard. It says out here in the second para, when an entity completes the construction of a qualifying assets in parts, and each part is capable of being used while the construction continues for the other parts, the entity shall seize the borrowing cost when it completes substantially all the activities necessary to prepare the asset for intended use or sale. They've given an example which is given in the standard. A business park is comprising of several buildings, each of which can be used individually as a qualifying asset, for each part is capable of being used while the construction continues for the other parts. I think all said and done, from the examination point of view, I think the date of cessation would always be comfortably given to you in the exams. I think that brings us to the end of this particular standard. So I think before we close, let me just consolidate the picture. So now when you're going to revise this particular standard, you know how you're going to look at this standard. You're going to look at the standard on a three-phase. At the first instance, just remember that I gave you a summary view of this particular standard, wherein we identified 7 crucial terms. And I think out of the 7 terms, the most crucial terms is the qualifying asset and in terms of the borrowing cost. If time would have permitted, I would have done some more practical illustrations with you. But I think considering that, I had to complete things in a 3 hours time frame, I have, made a little more stress on the concept bit with you. But I think with all that, you'll be able to easily practice. We've done some few questions also with you, but do your extensive practice on this area. The second focus area was on the accounting part, where I gave you the treatment in specific and general pool of funds. And then I gave you the concept of what we call commencement, suspension, and cessation. Commencement is the later of the 3 dates. Cessation dates, I think ID would always be given in the question. And I think for the suspension, I've just given you my peace of mind that what we are going to look at the avoidable, unavoidable factors and see if it is avoidable, then look at the target deadline. And if it is unavoidable in nature, then you need to see in that particular case, is it something which is common or not? So we're all set and done. So do your practice from the study material, do your practice from the past examination questions and the RTPs as well. So I think there's a question. Sumit, you said, if not capitalized, then the borrowing cost is taken to the profit and loss account. Yes, absolutely correct. Right, friends, so over to you for any questions which are coming to your mind. Any questions, or if you've got further questions as well, you can send them to the Institute mail. Then I will definitely answer those questions, if not now. So you're most welcome, and we can do that. So anyway, I think this was perhaps the last class with you in this particular batch. So I think it's been a pleasure, I think, interacting with most of you. I could see, a lot of common friends out here who have been in interaction with me. So the journey has been very interesting with all of you. So thank you so much. Thank you, Rashmi. And thank you, all of you, indeed, on that. So I think on that particular note, I would take leave from all of you and wish you all the best for the exams. And on that note, friends, I'm just going to end the class with you. Thank you, take care, and bye-bye.